They don't want recession, but they do need things to slow down for inflation to continue to go lower.
Fed's got a lot of work yet to do. I mean, we think inflation is going to be running still at 4+.
What I worry is on the other side, that the Fed works too fast and too much.
I think that the big issue we have in the market is that the Fed is not about to pivot.
We have right now about a 50-50 chance in terms of tipping over into a true recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures positive again, up 0.1% on the S&P. TK, we have ripped off the June lows.
We come off the June lows, and it's within an August gloom. John, I'm absolutely overwhelmed from hedge funds to what we heard from Linda Dissel yesterday at Federated. The caution out there, the reticence to believe in this equity rally, to start strong this hour with Howard Ward is wonderful. And within that, John, look at the news flow this morning going to Governor Bailey's 7 a.m.
Looking ahead to that rate hike, potentially 50 basis points coming up in about an hour from now. Tom, for me, it's not a wall of worry. It's a wall of doubt. I'm with you. Every single percentage point rally, there is just note after note saying, nope, fade this, nope, fade this. Tom, we're 19% higher off the lows on the NASDAQ 100, up more than 13% off the lows on the S&P.
I mean, I had my intern write the banner in August gloom. Let's do it again on radio. John says it better. It's an August doubt. I like that.
A big wall of doubt, Tom.
It's a doubt. We're very doubty.
Fed officials have done, Lisa, exactly what we anticipated they would do, and it's driven yields higher at the front end. Curves inverted even more.
Look at the inversion.
The equity market, though, is not paying any attention to that, seemingly, Bramo, over the last couple of days.
Well, here's the conundrum that I'm wondering about as you talk about the doubt. There is a doubt about the fundamentals that are driving that lower end rate picture lower, but there is belief that the Fed is going to ultimately come to the rescue of this market that is still embedded in this market, that eventually there will be rate cuts. I was reading TD Securities last night. Likely the expectation that quantitative tightening will stop next year in addition to rate cuts. This still is the belief embedded in markets.
When you say TD, we hear Priya Misra.
Exactly.
Priya Misra, Lisa, looking for negative 40 basis points
Call
on
the
2's
summer.
10s. Here we are. I mean, we're basically there, aren't we?
And when we take a look, Jeff Gundlach was saying, rough road ahead. He tweeted out this accelerating decline and this accelerating inversion, that 210 spread. How much does that indicate recession? It has most of the time. Now people are saying, well, we're already beyond that. How much is the belief and the lack of doubt that you're seeing in the price action really reflecting the backdrop of easier financial conditions led by the Fed?
Have you called it, Tom? Call of the summer?
Yeah, I think Priya's call is a call of the summer. I went back, John. I looked, did some fancy mathematics. I'm not going to bore you with on. It's a No Math Thursday. Let's be clear on that. But John, I looked at how fast we've inverted, and it's literally a Volcker equivalent. We've moved 170, 180 basis points down, down, down through zero into inversion, and it really harkens back to what we saw off near the crash of 87 into the Volcker 89.
The deepest inversion since the early 2000s. We'll build on that story for you a little bit later this hour. Futures right now, your price action shaping up as follows. Positive 0.2% on the S&P and the NASDAQ 100, up 0.25%. The lift continues. Yields bounce back at the long end. 10-year yields higher by a couple of basis points to 270, 246. And crude just about holding on to the 90s here, Lisa. 91.57 at 1%.
I don't understand the crude picture. We'll dig into that based on what we got yesterday from OPEC Plus, and then what we got out of the U.S. showing a decline in demand, a really mixed picture there, which we will look into further. What we're looking at today is in about an hour time, the Bank of England is expected to raise rates by the most in 27 years, following the 50 basis point trend that we have seen around the world as a minimum rate hike for the developed world. How much does this indicate the necessity of hiking rates into a weakening economy? I'm watching the pound. We have seen it completely weaken versus the dollar. How much further does that have to go? At what point do outsized rate hikes edify a currency versus weaken it further because it only undermines the economic trajectory even further? This is the conundrum facing the Fed. This is the conundrum even more facing the ECB. At 8:30 a.m., we get U.S. initial jobless claims. We have seen them start to tick up just very, very slowly from near record lows. At what point will this be the sign that people are looking for, that perhaps the Fed will take their foot off the brakes? At what point are people going to see this as strength if it stays at this flatline kind of level? strength giving support to this idea that the Fed needs to go a lot further. How much does that challenge not just the doubt in the market right now, but the opposite? The strength that we're seeing despite all of that doubt, John, that you were talking about. Today we get a slew of earnings: Lyft, Expedia, TripAdvisor, AMC Entertainment, Live Nation. All of these are interesting to watch for consumer discretionary spending. We've seen a really mixed picture, and we will continue to. How much do we sense, yes, companies adapting and adjusting, but forecasting an ongoing weakening in the backdrop of consumers?
Resilience, the takeaway of the last couple of weeks. Lisa, thank you. Joining us now is Howard Ward, CIO of Growth Equities and Gabelli Funds. Howard, I've got to ask you straight up, how durable do you think this rip-roaring rally is?
Well, we don't know, Jonathan, and that's the whole point. Investors don't know exactly how this script is going to play out. But if you don't believe in market timing, and history has shown that market timing is a loser's game, and I would challenge you to give me a list of the greatest investors of all time that have been market timers, because it would be a pretty short one. We don't know. What we do know is that a lot of stock prices are down 20, 30, 40, 50%, and therein is opportunity. And we're going through a period where the economy appears to be weakening further. We may or may not be in a recession, but recessions tend to be short-term phases in the history of time, and they've always been opportunities for investors to redeploy cash or to upgrade their portfolio by way of stock selection. I don't think this is any different time, and so I think the current, concerns about interest rates, we have to go back. Interest rates are still historically low. In the 1990s, which was one of the best decades for stock prices, the 10-year Treasury averaged more than 5%. It was higher than 6% towards the end of that period. And the earnings yield on stocks was well below the Treasury yield, sort of like a 3% earnings yield versus a 5 to 6% Treasury yield. The situation's completely inverted today. The earnings yield on stocks is 5 or 6%, and the bond yields are 3%. So there's some margin there for interest rates to go up and for earnings to go down. And stocks are still going to look, I think, historically attractive in terms of their pricing.
Howard.
So I think it's time for investors to realize that we don't really know what's going to happen. We know market timing doesn't work. Stock prices are down. Take advantage of it.
Howard, it's a Howard Ward August, and by that I mean all I'm hearing is the word quality. Everybody's discovered the word you've lived by for decades and decades with Mario, which is quality. Define for our audience on radio and TV this strange word, quality.
Well, Tom, that's a good question. In the world of investing, I think most people view the term quality to refer to a company's balance sheet and its ability to generate free cash, its ability to withstand a recession, difficult times, and that remains very much true today. And in fact, if you went back and looked at studies on stock market components, you'd see that the balance sheet strength is absolutely a trait of outperforming equities during very difficult recessions or bear markets. And so, sure, when we are possibly in a recession, we're in a bear market, quality is important in terms of giving you some protection to the downside, although certainly you're not going to escape unscathed.
I wonder how you feel about European banks right now, Howard. Just getting some news crossing the Bloomberg. This delivered from our team. They're reporting Credit Suisse and their executives are discussing reducing thousands of roles globally as the struggling European lender seeks to slash its overall cost base by an additional $1 billion. TK, there's no macro signal here. There's a Credit Suisse signal here. And let's be clear about that.
Yeah, I agree with that totally. And it's something we're going to see. And we're going right into the season, which is perfect, John. End of the summer, shape it up for Labor Day and on into the autumn in Europe. And it's going to be a right size off 51,000 jobs. I would say 2,000 is normal. 4% or so, John, is completely normal. The question in our reporting is how much more than that, and it seems to be substantial to get to that cost reduction.
That's how much. Let's talk about when. Lisa, expected to finalize its plans over the next couple of months.
Yeah, and this comes after other losses that they have experienced. How do they also keep talent at a time of cuts? We've reported about how much they've had to pay executives to keep them on board amid all the triage, and they're they're not going to be the last. There's also reports that bonuses are going to come down dramatically this year on Wall Street, in part because of the lack of capital markets activity.
Howard, how long have we talked about the trouble that European banks are finding themselves in? It feels like more than a decade. What's your take on this?
It's been more than a decade because they never really recapitalized properly after 2008-9. And so, one of my funds that I run is the Gabelli Global Growth Fund. We don't own any European banks. Of course, we don't own any domestic banks either. It's not the growthiest place. But in Credit Suisse in particular, is what a disaster that stock has been. It's just been one calamity after another. And they've tried to bring in new executives, and nothing seems to work. So I don't know what the answer is there. Hopefully they can get their act together at some point. Come on, board, do your job.
It's difficult. Howard, thank you. As always, Howard Ward there of Gabelli Funds. That stock intraday up a little more than 2%. Tom, year to date and over the last several years, it's been a struggle for that name.
Yeah, it has as well. I'm doing a compare and contrast to UBS with 71,000 jobs versus the 51,000 at Credit Suisse, and that surprises me. I look at UBS as maybe better run, and so where's that proportional number to Credit Suisse? And my tilt, John, is yes, that's right. It's to a lower number, reduced from 51,000.
Hey, Thomas, the same old question. What do they want to be when they grow up? How many times have we asked that of Credit Suisse?
It
of
goes
other
way
European
back.
names too, of Deutsche Bank, etc. Take your pick.
I used to read their securities research a million years ago. Good morning, Mark Flaherty, who was absolutely fabulous on the oil business. And I'd literally look at their font and go, do they understand their font and their securities research is unreadable? I mean, it's little stuff like that, and it's big stuff like some of the huge errors we've seen recently.
I think there's some bigger stuff than that, Tom.
I think there would be
That's for
bigger
sure.
stuff than that.
I don't even think that's the small print on
DLJ,
the
you could read
complaints.
the research. Credit Suisse, you couldn't.
I think that's just one of your complaints.
They don't use Helvetica.
Lisa, I just wonder what David Harrow's
No,
thinking
you don't
right
use
now.
Helvetica.
Yeah, exactly. When do they get out?
Monotype
When does he
Bembo.
just throw up his hands and say, forget about it?
The patient
John-
capital that's been
John,
behind
the
that name.
Bank of England uses
Essentially
monotype
patient.
Bembo.
Tom, is this your rant of the morning?
This is my font. Yesterday we did Bob
What font
Seeger.
they use?
Today we're doing fonts.
There was a great documentary on that.
If anyone would like an advisor to your board, Tom's available. Futures on the S&P up 0.2 from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China has begun military drills around Taiwan in response to House Speaker Nancy Pelosi's visit there. One of the exercises involved missiles being fired into the sea. Taiwan is downplaying the effects of the drills on shipping and airplane routes. The Bank of England today is expected to raise interest rates by the most in 27 years. Investors are expecting the first half-point rate hike since 1995, despite risks of a recession. The BOE also will give details of how it plans to reverse some of the $1 trillion in stimulus it pumped into the economy over more than a decade. The US Senate has voted overwhelmingly to add Finland and Sweden to NATO. It's a move aimed at bolstering the military alliance after Russia's invasion of Ukraine. Turkey is still threatening to block the two countries from joining. And there will be another attempt to save the landmark Iran nuclear deal. Diplomats from Iran, the US and Europe will meet again in Vienna after months of deadlock. The accord fell apart after Donald Trump withdrew 4 years ago and reimposed sanctions on the Iranian economy. That led Iran to step up enrichment of uranium. First half profit at Glencore more than doubled to a record thanks to soaring coal prices. The world's top coal shipper will return an additional $4.5 billion to shareholders in dividends and share buybacks. Glencore has been one of the biggest winners from the global energy crunch. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Earnings season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft,
with exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio, the fastest numbers and analysis you trust.
The
the president wanted to see oil prices down, wanted to see gasoline prices at the pump down. That's what we're seeing. And I think what's very remarkable here is that we're seeing that happen while one of the largest oil producers in the world is in the middle of a war in Europe and is under sanctions. So this is not an easy time to manage energy markets.
You can say that again. That was Amos Hochstein there, the senior advisor for energy security at the U.S. Department of State from New York City this morning. Good morning. Here's the price action, adding to yesterday's really solid gains in the equity market. On the S&P up by around about 1/4% on the S&P. On the NASDAQ 100 up 0.4%. Really strong rally that Max Kettner of HSBC calls wishful thinking.
Wow, what a
this
note.
morning. He
What
does
a
though,
note.
and I appreciate this. At the end of the note, he says, where could we be wrong? I have a lot of time for that. And he goes on to say, Tom, if inflation does indeed surprise to the downside or growth stabilizes much more quickly than we thought, then the recent rally in growth over value could continue.
Well, that's where at the bottom of research note, you put in your risk factors, and that's well said by Max Kettner. But, John, it's a piercing note from HSBC, and he doesn't mince words. He says you need to be in U.S. dollar cash. Rarely do you see that from a house.
For this buy and I think rally to continue, we
Yeah.
need to see further repricing of rate hike expectations and another sharp drop in real yields. But market pricing of risk assets, he goes on to say, Tom, is now very much out of line with our cyclical growth indicators. Tom, I've got a long list of banks now, just pushing back against
Oh,
what
it's
we've
amazing.
seen
It's
over the last
amazing.
month.
And Bloomberg News features Bernstein and someone else this morning as well on this. Let's get to Washington right now. The heat of the summer is extraordinary, and it is wrapped around the always beautiful and dry heat of Arizona, and that would be Senator Sinema. Jack Fitzpatrick joins now with Bloomberg Government to keep score. Jack, it's really moved away from the news on this Thursday morning, but nevertheless, here we are looking at tax analysis. I go to Richard Rubin in the Wall Street Journal, his wonderful, legendary tax work of the worry of corporate taxes filtering down to mere mortal people. Is that the attention of the senator from Arizona who was so important in this debate?
That has gotten some attention, and the argument, especially from Republicans, that
Yes.
this would raise costs to consumers and not just from companies, that is becoming a more significant talking point. I don't know that I can necessarily confirm that is the primary focus of Senator Sinema. For one thing she had never signed off on in this package is the carried interest measure. If that had to come out, it wouldn't necessarily break down the whole thing. It's not a massive amount of revenue, but she has raised some concerns about exactly who the minimum, the 15% corporate minimum tax rate would apply to, and if there are some changes that might be able to be made on deducting investments for the depreciation of assets. I don't know necessarily that the Joint Committee on Taxation's score on this potentially raising costs for everybody else is the primary focus for her, but I do know, one, it's something Republicans are playing up and that you'll hear about on the campaign trail, and it's making a lot of noise.
Yeah.
Two, Sinema really is the person to watch who's been hesitant about increasing taxes overall on corporations. She's got concerns. It doesn't mean she's going to tank the bill, but she has become the big X factor.
Well, you know, just in the movie of the morning, Greg Valliere published this moments ago and says it's too good to be true. What's the calendar here, Jack? I mean, we're distracted with Bank of England, Jobs Day tomorrow, and the rest of it. Should we be focused on this legislation into the weekend, into the Sunday talk shows?
Yeah, we don't know when they're going to move ahead with the process to get this bill across the floor in the Senate, but it's a matter of days. That's the goal.
Okay.
If they hit a big hurdle with Sinema, it could get bumped back, but they want to do this before they leave. They were supposed to leave for their August recess at the end of this week. Now the conversation is, does it happen over the weekend? Does it happen early next week? But if they can get this through, the Senate's going to try to do it in a matter of days, and then the House plans to come back next week to actually clear it and send it to the president if possible. So over the course of the next week or so, that's what we're hearing for this bill.
Jack, in the meantime, there is a bipartisan effort on Capitol Hill to pass a bill naming Taiwan a major non-NATO ally, which has been the policy for decades in the United States, but not formalized in this manner. And it's put President Biden in this awkward position where he's pushing back and getting some heat for it Why is it in his interest to push back at a time of heightening concerns about China and bipartisan agreement that the U.S. needs to take a pretty straight line on this?
Yeah, well, the timing may be an issue. It's a sensitive time with Pelosi's trip to Taiwan. You're right that this would formalize a relationship that already exists between the U.S. And Taiwan. There's other stuff in there, but it doesn't seem to be the point of objection. There are a few $1 billion in security aid that is not unusual for the U.S. to send to Taiwan. And that kind of leaves the issue of timing and the sensitivity of communications with China on Pelosi's trip as the likely main culprit. Chris Murphy, a key senator on this, said he has concerns and there might need to be a rewriting. But really, for all intents and purposes right now, the White House has kind of pumped the brakes and at least bumped this back until after the August recess. There was supposed to be a committee vote yesterday. They didn't hold that. So it may be a matter of a delay at the request of the White House, because it's not just a fundamental debate over the U.S.'s relationship with Taiwan. It seems to be more a matter of how that plays publicly at this point in time in the context of Speaker Pelosi's trip.
Jack, just quickly, can you clarify for me at least why a Democratic senator would be against closing the carried interest loophole? What's her justification for that?
I think the biggest push against it, one, it wouldn't raise a bunch of money. Two, there are arguments relating to the assumption that those fund managers are profitable in any given year. You may hear more from the fund managers themselves on exactly how this would affect them, but there's some argument over who it is unfair to, in also the context of, in a more than $700 billion bill, this is supposed to raise maybe $14 billion. So it is one of the, arguments aside, it may be one of the slightly less important measures in the bill.
Jack, thank you. Jack Fitzpatrick, thank you very much. Tom, it's not really about the money raised. I guess it was always about fairness for this party.
Well,
and this is something that's not going away. And I think this is the frustration that the Democrats have with Senator Sinema, that on something like this, it should be pretty straightforward.
Right. I mean, John, in the ballet of the British elections, Truss and Sunak and that, I wonder how fair translates. What I know in America is, John, when you hear the word fair, all your radar goes up.
I know, but that word's been used a lot over the last year or so.
To be fair.
To be fair.
Yeah.
Futures up 1/3% from New York City this morning. Good morning to you all. A Bank of England decision 35 minutes away. Equity futures up 1/3%, climbing a wall of doubt. We've talked about that this morning already. Again, on the Nasdaq up 0.5%. The data yesterday, the ISM robust. The S&P Global PMI, not so much, but we're choosing to focus on the good stuff and not the bad stuff. So the equity market ripped yesterday off the back of the ISM, ignoring the S&P Global PMI, which I know Lisa's got a lot of things to say about. And in the bond market, we responded to more hawkish Fed speak. Yields higher again for a third straight session, up 3 basis points at the front end. Your 2-year up by about 3 basis points to 3.1%. We've talked about that inversion, so 2's higher. Yesterday, 10's lower. Came very, very close to negative 40 basis points. Just today, Tom, you've got to go all the way back to the early 2000s, spring 2000, when we had about negative 56 basis points. We're not a million miles away, TK, on 2's versus 10's.
2's 10's is a huge deal. To me, it's front and center today, John. Currencies have quieted down a little bit. We've got an equity rally, including advancing this morning. I think Howard Ward pushed the market higher. John, 2's 10's is the heart of the debate right now.
Amazing to me, Tom, how few people believe in this rally. With the exception of maybe...
It's an August of doubt.
Maybe Credit Suisse and JP Morgan. Others do not see this playing out very well at all. HSBC, as we discussed moments ago, calling all of this wishful thinking.
Yeah, I think, John, there's some optimism out there. But to be honest, it's being drowned out with the force of the doubt, the force of the gloom.
Resilience in the earnings.
Yeah.
1. I'd say the ISM yesterday, strong, robust. 2, actually picked up. So many nuances here we're trying to work through, Tom. We've got this inventory story, the switch from goods back over to services. I think that's distorting the data in a way that is confusing for many people as well, Tom. And these are difficult moments to work out where we're going here.
And the shock of double-digit inflation, which takes us over to the central bank ballet. Right now, that ballet is on Bank of England. John will be leading our coverage of that here in 29 minutes. Jennifer McCune, right now, former Bank of England economist, head of the Global Economic Service at Capital Economics, will help us here and particularly help me. I want to start with what won't happen, Jennifer. The silence of Governor Bailey. What does he want to avoid talking about this morning?
Well, I'm not sure he'll want to avoid talking about anything specific. Of course, the Bank of England has come under some criticism for not acting faster, for not acting sooner. He'll want to stress that a lot of the rise in inflation has been about the supply side. That there was relatively little that the bank could have done about that, and to avoid further criticism on that front. But I think the key for the bank will be in what it's signalling going forward, what the vote shows us, what the forecasts show us about just how fast the pace of tightening will be in future.
Does he make the decision, or is there a different structure there than the U.S. Central Bank? I mean, Catherine Mann, as a visitor from America, I believe is very hawkish, and there's others very dovish. Do they matter in the debate, or is this all about Governor Bailey?
Yeah, no, absolutely they matter. There's a vote. And while Governor Bailey will put forward a proposal for what the change should be today, it will be down to the committee at the end of the day. So that those votes will certainly be playing a role, and we think there's likely to be a pretty big shift at this meeting in favour of a 50 basis point hike.
The most important thing to recognise, Tom, when it comes to the Bank of England, say the Federal Reserve, is just the disproportionate importance of bank rate at the Bank of England, Tom, compared to funds rate over at the Federal Reserve, because capital markets in the US are so important compared to, say, the UK. I remember when Governor Carney took over, Jennifer, and you'll remember this too, he talked about the importance of bank rate for consumer loans, for corporate loans, and that's very, very different here in America. So can you help me understand, when it comes to the Bank of England, how they push through bank rate just a little bit more, say, compared to, say, capital markets?
Yeah, well, everything's essentially priced off bank rate. It plays a really important role in the UK economy. Mortgages, in particular, are more often at variable rates than they are in the US, and that means that the pass-through from bank rate to those variable rate mortgages in particular, and hence onto households, is pretty significant. So it's very much a live issue, what's going to happen to the policy rate, and people watch it, even in tabloids in the UK, the bank rate is well known, and people generally, I think, know what that rate is, and will be very interested to see whether there is a 50 basis point hike for the first time since the Bank of England's independence.
Given the importance of that rate, why is the Bank of England thinking about outright selling gilt? And they could announce that plan as soon as today.
Yeah, they could do. I think that's much less important than what's going to happen to bank rate. We already knew that the Bank of England's balance sheet was going to be reducing in size over time, because it's allowing assets to mature. There are significant assets maturing, and it's not rolling that over in full. The question now is whether it's going to start actively selling gilts. We might get some indication of that today, but I think there's an assumption that it will do later this year and going into next year. So if it's just backing up that assumption that's already in the market, then I wouldn't expect a major reaction to that.
Jennifer, taking a step back, the Bank of England is uniquely positioned in a moment of pain where central banks are having to raise rates at the fastest pace in decades in the face of economic weakness. Bank of England faces perhaps more than the Federal Reserve and really is at the epicenter. How do they message this? How do they message what they are going for at a time when the economy is already weakening so substantially that you're seeing it translate into real-time data?
Yeah, I mean, that's absolutely right. It's an extremely difficult position for a central bank to be in, and I think it will have to convey that dilemma between the fact that inflation has been rising very quickly. It's very, very high, even compared to other advanced economies where inflation's also high. And and wage growth is rising. We've got pretty strong wage growth in the UK too now. Real concerns about second round effects, and that could lead to significant persistence in inflation, but at the same time, as you say, real weakness in the real economy, real signs that very high energy prices and the effects of that on real incomes are starting to weigh on spending, and that's really dragging on the economy, and a really big risk that we fall into recession. Actually, we are predicting a technical recession in the UK economy later this year, but at the same time, we think that the Bank of England will continue raising rates to a peak of 3%. So it's likely to come under some criticism for that, but there's little else that it can do with these inflationary pressures.
Jennifer, from your seat when you were at the Bank of England as an economist, can you give us a sense of how important it is to the members on that central bank when they take a look at the pound and how much it has deteriorated versus both the euro as well as the dollar? This is an inflationary force. How do they deal with this? How do they factor this into what they're looking for in their rate decisions?
Yeah, well, it is a factor, and it feeds through mechanically into the Bank of England's inflation forecast. So the inflationary consequences of sterling's movements will be playing a role. But the Bank of England has been very clear always, and even in the recent past, that it doesn't target the exchange rate. It's not an explicit factor. But what will be playing a role is its influence on the inflation outlook and any additional upward pressure that it might be putting on inflation. I think really the labour market is the absolute key, though, and what's happening to wage growth and what businesses, including within the Bank of England's own survey of decision makers, think that they're going to do with wage growth in the future. And at the moment, the worrying evidence is that they intend to raise wage growth further.
Jennifer, great to catch up, especially with someone with experience of the Bank of England and inside those walls. Jennifer Micchione there of Capital Economics. TK, I mentioned that difference between the Bank of England and Fed funds. If you have a variable rate mortgage and that rate goes up, the next month you'll see it. And that's very, very different
That's
to how
very
things
British.
play out.
Yeah, let's be clear, John. There's a lot of variable rate mortgages in the United Kingdom, right?
There are many, Tom. And in fact, that worked out through subprime, Tom, and the crisis around that, because if you had a variable rate mortgage back then, it dropped down to close to zero, didn't it, and stayed there for a long time.
Yeah, but you had the 6,000 square feet in Notting Hill, so that worked out as well. John, look at the difference in curve inversion. The difference in yield between the 2-year and the 10-year, the massive inversion in the United States really hearkening back, negative 37 basis points, and the flat line in the United Kingdom of 1 basis point. John, the pros make a real distinction here about deep inversion versus flatline.
And some serious inversion developing here in the United States, Lee. So that's something that you've really got to think about a little bit more.
Well, what you could say is that this is faith that the market has in the Federal Reserve. I mean, you could talk about Fed credibility, but in some ways, this is basically saying the Fed is as credible as ever before, and they're going to get rates back down to that 2% level or below. They're going to get inflation back there, and that is what you're seeing in the long end, even as people ratchet up what the Fed has to do to get there. And to me, that's sort of what the indication here is. They are expecting more work on the front end, which doesn't speak well to the economic outlook. Again, fueling those doubts.
Do you want to explain this equity market move on the Nasdaq up 0.6 of 1%, on the S&P up 0.4? A Bloomberg subscriber reached out to me, Tom.
Oh, here we go.
Smart individual, and they've got a lot to say about nominal growth and the importance of nominal growth and what that means for earnings.
Well, you know I'm there.
I know you are. I know you are.
And others, but let me explain that into the timeline of the third quarter into fourth quarter. If you say a resilient nominal growth, at the same time you're saying extended, more persistent inflation. That's sort of the translation of that, John.
I'll pick up on the price action now, Tom. Up around about 0.4 on the S&P, on the Nasdaq, up 0.6. Your bond market, TK's all over.
Dow
It looks like
futures
this.
up 94.
It's up a couple of basis points. Thanks for that, Tom. What's that, a third of 1%?
Yeah,
something like
that.
that.
I don't keep track of the
It's not what it was 20 years ago, that's for sure. It's a joke, Tom, about points on the Dow. Anyway, whatever. All right. The crude market looks like this, up about 1%, 91.61. What did you make of yesterday, Tom? Demand for gasoline in America. The driving season is not developing in the way that it typically does. People aren't driving.
Come on, it's an historic summer. We all know that. Our kids are bouncing off the walls post-pandemic. All the rules are being broken. Why should we have a repetition of normal times this summer? We're not.
Demand destruction, Elisa, is in the data.
Yeah, and that lack of driving, how much is that? What's behind the gas prices? Not the SPR release, not any additional production from anywhere. It's really the demand destruction that you're seeing in real time.
Paul Sankey has things to say, the founder and lead analyst at Sankey Research, joining us very shortly from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. Ukraine's President Volodymyr Zelensky wants direct talks with China's Xi Jinping. Zelensky says that Beijing hasn't replied to Ukraine's requests since the Russian invasion in February. He told the South China Morning Post that China could, quote, put the Russian Federation in a certain place. Bloomberg's learned that Senator Sinema is seeking to curb corporate taxes and keep a brake for private equity in the Democratic's economic package. The Arizona Democrat will be a pivotal vote. Sinema wants to drop a provision from the bill that would scale back a tax break for fund managers known as carried interest. She also wants to narrow the 15% minimum tax on financial profits. Credit Suisse is considering thousands of job cuts worldwide in an attempt to cut costs by an additional $1 billion. Bloomberg's learned that the Swiss bank is weighing an aggressive plan to reduce headcount. Credit Suisse has more than 51,000 employees, is trying to move back to profitability after both losses and scandals. SoftBank reportedly has raised as much as $22 billion by selling Alibaba derivatives. That's according to the Financial Times. The newspaper says SoftBank sold prepaid forward contracts on Alibaba that allows the Japanese company to raise cash immediately whilst keeping open the possibility of holding on to the shares. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
It's hard to overstate how disappointing this OPEC Plus decision is for the Biden administration. Frankly, it's the geopolitical equivalent of a slap in the face. The Biden administration made a huge miscalculation.
That was Isaac Boltanski, the BTIG Director of Policy Research from New York City this morning. Good morning. Amos Hochstein of the White House pushed back against that summary, that characterization of that decision yesterday. He said it was more than just about oil in Saudi Arabia. Futures right now up 1/3% on the S&P, and the Nasdaq up 0.5%. Yields just a little bit higher too, up 3 basis points to 273. Get a Bank of England decision in 12 minutes time, then on to data out of the United States a little bit later this morning, 8:30 Eastern, jobless claims. Tom, how much crude is actually out there for OPEC Plus to be pumping? That's the big question.
It's a mystery right now that you see not only in OPEC Plus, but really worldwide. It is a different world after what we've seen, and the bets made by strategists, some saying 120, even 150, maybe a few higher, and others really saying, wait a minute, demand is disappearing. Think $90 a Brent barrel, even down to a whispered 80. Paul Sankey has seen all of this before. On the edge of legendary, the founder and lead analyst at Sankey Research, who writes a strange and twisted note, which is almost Sankey's zeitgeist of what he's seen in earnings. Paul, I want to go to your wheelhouse, which is gaming the capital expenditure culture and belief of the big oil companies, the E&P companies, given capex inflation. It's gotten expensive to find the next marginal barrel.
Well, not in the Permian. I mean, I think they know where the oil is in Texas, but what they've stopped doing is spending the money that you're referring to on global exploration or trying to find the next big thing. Now, they have found one next big thing, which is Guyana, but that's just about all that's been significantly discovered over the past decade. And as you say, the expense of finding oil and the uncertainty of finding new oil particularly is really constraining global capacity badly. And then, as you've referred in the program already, OPEC just is out of capacity. I don't see it as a slap in the face from OPEC to the Biden administration. I see it as more of a shrug or a we're powerless move, that they really can't add any capacity. There's only Saudi and UAE. that have any spare capacity left. And as was also noted, OPEC actually highlighted that they don't have any spare capacity and they're worried about it. So there's a real problem out there. And if it wasn't for the SPR release, the million barrel a day SPR release, we would be a lot higher.
They're not keeping it a secret. So walk me through things for next year, Paul. If we don't get a recession, if China comes back online, what this commodity market actually looks like, particularly in crude.
Yeah, funnily enough, I was thinking about that just this morning because 2023 does set up, and beyond actually, for very, very strong. Now, the one thing that is notable is that we're seeing weak US gasoline demand, and people are blaming that on government conspiracies and other nonsense. I think the cars are more efficient. If you look at vehicle miles traveled, they're high. So it's not necessarily a change in behavior. What it is a change in the kind of vehicle people are driving. And it's obviously not EVs, electric vehicles. It's just more efficient cars that turn off in traffic jams and everything else. I think that's what we're seeing, combined with marginal behavior change where people are less wasteful with gasoline when it's expensive.
Wait, Paul, are you saying that that shift in the type of vehicle has happened in the past 2 years so dramatically? Because what this data showed from the EIA was that the amount of driving over the summer has been less going back even to 2020 during the peak of the pandemic.
Yeah, you've got me a bit with that one because the speed of the change does look like there's also marginal behavior change. But I think underlying it is a rolling significant increase in new car efficiency that would have a significant effect at the margin on US gasoline demand. Well, there's a tremendous amount of demand for gasoline in the US that's discretionary. And I think people also just take that one less trip, and everyone tends to behave in the same way. And that's the other effect that we're seeing as a result of high prices.
Paul, are you surprised that the market isn't responding more to the OPEC Plus saying themselves that they're bumping up against the limits of how much they can produce? That previously would have produced a really big response in markets. And it basically was just another thing in the day that got forgotten very quickly.
Yeah, I think it's like the yield curve. I think what you're seeing is the back end of the curve for oil is holding up. I still think it's low. But it is holding up as the front month is coming down. The front month is being attacked by the SPR in a very big way. So I think the big question, as John is highlighting, is what happens when we get China back and then the SPR has to turn off, I think, post the midterms. That really sets up for a very powerful 2023. This tape today, this equity tape, isn't buying 2023. It's buying a short-term bounce, short covering move. And as a result, nobody wants to own an oil company as they see the oil price falling towards turnaround season for the refiners. Turnaround season for the refiners will be the more important demand effect that we see over the coming months. So I'm kind of bearish right now, to be honest with you.
What's your oil price out 1 year? I mean, I'm confused here in that I'm hearing so many cross currents. Are you able to guesstimate Brent a year out?
Well, we had said that we thought you'd see 110 to 150 through summer, so we're losing that. It's tried to hold that level, but has essentially failed. I think it's easy to argue for $100 oil on an ongoing basis starting in 2023. I don't think you'll do much above 150 over time, simply because the demand elasticity, the effect of the strong dollar combined with that kind of oil price will hold you below that level. I'm not a buyer of the 200, 250 type crazy numbers. I just don't think we can sustain that.
Paul, just to be clear, you slipped in the word bearish. Near term, what's the downside?
Bearish? Me? Nobody wants a bearish oil analyst. I think over the next few months, as long as this SPR, which is going to keep coming at 1 million barrels a day, you've got to think that the whole of OPEC just added 100,000, and we're pumping a million a day that the US refiners can't absorb. It's too much for their capacity. They're running at full capacity. So the oil is actually being exported. Now, that is terrible energy security policy. There's no question about that. It's good market policy because they're hammering the oil price. So I think the other way of looking at it is, wow, we're at 90 with 1 million barrels a day of SPR release, which is an all-time historic high. It's a huge number at the margin, to be releasing that much oil on such a sustained basis. And it's going to happen for months more.
Downside, Paul, what's the number?
People are pointing, technical analysts, great chart readers like you, John, are pointing at 80.
Okay. Paul Sankey, thank you for Sankey Research.
That was a great find.
I know. Paul, thank you. Setting the stage for a rally over the next year, though, Tom. Everything that Paul was saying just then is the reason the energy bulls aren't going away anytime soon.
It's not only the construction of a barrel, which Sankey's legendary for, but also his work with Adam Szymanski years ago. And that key word in there, John, elasticities. The translation of that from fancy bow tie talk is responsiveness. What is the responsiveness of demand to that move in price? You heard Mr. Sankey pour some cold water on the 150 plus price guess.
I heard the same thing. In about 5 minutes, we'll bring you the Bank of England rate decision. We'll catch up with Jordan Rochester, the G10 FX strategist over at Nomura. This market, The Economist, looking for something close to 50 basis points from Threadneedle Street. We'll find out if that's what we get in a few minutes' time. Going into it, futures stateside positive, up 1/3 of 1% on the S&P, on the Nasdaq up 1/2 of 1%. Yields a little bit higher by a couple of basis points, 272.64. With Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
They don't want recession, but they do need things to slow down for inflation to continue to go lower.
Fed's got a lot of work yet to do. I mean, we think inflation is going to be running still at 4+.
What I worry is on the other side, that the Fed works too fast and too much.
I think that the big issue we have in the market is that the Fed is not about to pivot.
We have right now about a 50-50 chance in terms of tipping over into a true recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is the biggest rate hike from the Bank of England in 27 years. Live from New York City this morning. Good morning, good morning. With Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg Surveillance. Futures positive by 1/4 of 1% on the S&P. TK, it's 50 from the BOE.
50, and it's a different 50 than the American economy. I really have trouble, John, with the equivalencies of the Fed to the Bank of England. It's two different stories. You're expert at this. I know Lizzie is as well. But the answer is sterling a little bit weaker off this historic moment.
In line with expectations, sterling unmoved off the back of this. Lisa, cable 121.80.
You know, looking at this is again a bank that's having to hike into weakness. How much does this outsized hike give some support to the pound? You are seeing a little bit of support. Is it enough, though, to be disinflationary at a time when that's exactly what they need in the face of incredibly high inflation and not a sign that it's really going to deflate on its own?
The split 8-1. 8 Bank of England officials looking for 50 basis points. Just one looking for a 25 basis point hike. Going through the headlines for us. Outside the Bank of England this morning is Lizzie Burden. Morning, Lizzie.
Morning, Tom.
What's your take on things?
Well, so this is very much in line with expectations. It was well trailed. Andrew Bailey, the governor, had said in his Mansion House speech that 50 basis points were on the table, although he didn't say it was locked in. So this is very much what markets and economists had expected. Obviously, there's lots of international pressure. The Fed and the ECB had gone for jumbo hikes, but it'll hurt consumers. It'll hurt people with mortgages. Rightmove says that the average home for first-time buyers mortgage payment will rise 5.5% to just over £1,000 a month. So it's going to be much harder for first-time buyers to get on the market at a time when that's really a political priority. You've also seen out of the BOE, the recession forecast is changed, the growth forecast have changed. So they're now saying that a recession will begin in the fourth quarter and last all the way through next year. Frankly, John, it's a bit meaningless when we're about to get a new Prime Minister in the UK. They're obviously going to do more fiscally. Liz Truss wants to unleash a whole load of tax cuts to the tune of about £30 billion. Yes, that might be inflationary, but surely it will help to cushion the blow in recession terms. The bank's also boosted its forecast for the peak of inflation. So remember, it had seen double-digit inflation in the fall. It's not just that now, it's 13.3% in October, and that reflects the higher energy prices that we're going to see in the fall, but that could be even worse next year. We're going to get the press conference at 12:30. I think that you can definitely expect Andrew Bailey to get a load of questions about the political pressure he's been under recently. The front runner to be the next Prime Minister, Liz Truss, has been particularly scathing on the bank's record, curbing inflation, actually saying that she wants to change the BOE's mandate. But I think Andrew Bailey is probably just going to bat those questions off to the Treasury because it's for them to set the mandate.
13% inflation in Q4, just brutal. Lizzie, great work. Lizzie Burden this morning outside the Bank of England. We'll hear from Governor Bailey in about 25 minutes' time. Tom, 13% inflation. recession in Q4,
Yeah.
the Bank of England hiking 50 basis points. It's pretty toxic stuff. As Lizzie said, though, the fiscal picture not clear just yet.
For our American audience, the heritage of that statistic, John, 13.2%, I can't say enough about that. John, when we go to the United Kingdom, most of us go to what? 3 zones of, we get to Harrods is our farthest west we go. Once every 5 years we go to Bath to have a bath. Other than that, John, there's a whole nother United Kingdom out there that will truly be flat on its back with 13.2% inflation. And I'm sorry, this harkens back to the depression and the deflation, the harmful deflation of the 30s. It's different over there.
And they're getting squeezed, and they're getting squeezed even harder. Looking at the reaction in gilt yields, yields lower at the long end by about 3 basis points, a bit higher at the front end by 3 basis points. Sterling fades a little bit. Cable negative by almost 1/10 of 1% now, 121.42. For those of you just tuning in, I'll give you a snapshot of the broader market to get things started stateside. Futures are positive by 1/4% on the S&P 500. On the NASDAQ 100 up by 0.4 of 1%. So we're lifting this equity market once again. Yields higher by a couple of basis points. Call it 2 basis points higher on Treasuries. 272.46 and some curve inversion that we haven't seen for a long, long time. Very close to negative 40 basis points. So 50 basis points is the hike from the Bank of England. Standing by, Jordan Rochester, G10 FX strategist over at Nomura. Jordan, your reaction to this decision by the BOE?
Well, John, it's the simple case that this wasn't a big surprise from the Bank of England. We were expecting around 50 basis points. That's what we got today. Conversations with clients as well. 50 basis points from the Bank of England is probably the last 50 basis points from them. It's the first and the last since they became independent, probably. As for us, the view is that the situation in the energy market will decimate the incomes of UK workers. The consumer confidence is going to continue to fall. Consumption is going to continue to slow. And the Bank of England is going to potentially revise down their inflation forecast. So the last rate hike of this cycle is probably going to be November, is the view from us. And that means it's very unclear to me why today the Bank of England doing 50 is a reason to buy the pound. Now, if they did 75, you would have seen sterling head higher. But, John, the problem for markets is we're just not used to trading 1970s style stagflation. Yeah. Tom was mentioning there the 13% inflation really decimating people's ability to spend. The Bank of England will reflect on this. They've already put in their forecast. Today we saw they think the price cap goes up to 3,500 in October. That's about right. It's going up again in January to £3,800 per year for the average household. This is a massive amount of money coming out of the system just spent on energy.
Jordan, I think very much different than the Fed, where we have all the different Fed presidents, including Kansas City, where we'll visit at Jackson Hole. We perceive the Bank of England as the city and maybe London as well. What does 13% inflation do to the Bank of England's relationship with to go to the Premier League this weekend, to Liverpool, to Leicester, to Newcastle? What is the BOE relationship with the inflation the North will face?
Well, indeed, you mentioned, Tom, we haven't ventured past Harrods. So one day me and John will have to take to our hometown, north of Birmingham and Sutton Coldfield. It will be felt a lot in the north. We're seeing lots of strikes being held around the UK. I was listening to one of the NHS union representatives just earlier this week, and the pay rises they're being offered after inflation adjusted, roughly 10% real pay cuts. It's essentially like asking workers to do a whole month of the year working for free or losing all of their statutory holidays. So the impact will be we're going to have more labour market strikes. This will potentially see wages go up. So it puts the Bank of England in a really strange place that they're raising rates. The consumer is being squeezed. That does lower their inflation forecast perhaps ahead. But if we do get a wage price spiral, this is very 1970s like. So they're going to be keeping an eye on that. And the way the Bank of England looks at it in the north, they use the Bank of England agent summary. We've only just got it now, so I'll need to look through those details. It came out at the same time as this meeting. But they do get a holistic picture of the rest of the country through the agents, and they will be seeing this story that I've just laid out playing out around the country.
Jordan, I want to dig a little deeper into your idea that November will be the last rate hike. It will be the end to the rate hiking cycle of the Bank of England, raising questions about the front loading of monetary policy and monetary tightening. That has been a big discussion. We have the Bank of England warning of a long recession. At what point does that pause in rate hikes lead to rate cuts, in your view?
It could happen quite quickly. The Bank of England was one of the first major central banks to raise rates. They started in December last year, whilst everyone was still talking about transitory and Omicron. So when the Bank of England kicked things off in December last year, it gives them the sort of the ability to end their rate hiking cycle earlier than most. and also introduce the idea of cuts. So we're looking for May cuts from the Bank of England, that sort of timing. And why? So inflation will still be higher than 2%. I actually think the risk reward is inflation doesn't fall down to 2% as quickly as the market's pricing, but the central banks will react to the situation in credit markets. If you look at the crossover spreads, you look at the ECB systemic risk, whatever you want to look at, the credit stress in the market is roughly around the same levels as the worst moments in the coronavirus panic of March 2020. I suspect the energy prices, 10 times higher than they were on average in Germany, will knock out the business models of many manufacturers. We're going to see credit stress lead to higher defaults, lead to unemployment rising. And that's why in Q4 and Q1, the story will change for central banks. Even though we'll have high inflation, there could be a dovish moment.
Jordan, South Sterling, still the trade for you?
Indeed. I think we've had a big move higher up to the 122 level. Not very fun for me holding a short for about that period, but the trend is lower in sterling. It has the same problems as Europe when it comes to this energy crisis. Its central bank has just done 50 basis points. Look back to the ECB meeting. They did 50 basis points. What did the euro do? Nothing. So just because central banks are doing these big rate hikes, it's not enough to defend their currency against what's a big terms of trade shock. The pound should essentially be trading towards 115 down to 110, just based on terms of trade alone. The price of the UK's exports have fallen, whilst the price of the UK's imports have skyrocketed. The UK needs a weaker currency to help its exchange rate.
Ugly. Jordan, just quickly, can you imagine if the Fed forecast a recession like this one that starts in 4Q and runs through the whole of next year?
Good point.
Could you see them ever doing
exactly
that, Jordan?
What we're forecasting.
Could you
it's
imagine?
What we're forecasting at Nomura, so I can see it happening, but they'll be a bit slower than us to get there.
Jordan, I know that's the Nomura call. Jordan Rochester there of Nomura. We'll take TK to Little Aston and not Aston, and that's a snobby joke, Tom, from Birmingham, which you won't get, but Jordan does.
You know, when you tour on, Lisa, help me here. Between Ferro and Rochester, I can only understand about one every 4 words.
Really?
Yeah, I mean, it's lost in translation.
Should do Duolingo for
It's like
British.
watching Peaky Blinders. I'm like, give me another drink.
Come on, guys,
can't
brutal.
understand him.
I understand it all. I don't think it's brutal.
I know, he's just rude sometimes. That's all. Can you imagine if the Fed forecast this, Lisa?
They would never
forecast in 4Q that goes for the whole of next year.
The issue is not the plausibility of that happening. The issue is them saying it out loud. The Fed would never say that out loud, and that, I think, is the distinction.
50 basis point hike by the Bank of England. Sterling weaker by 1/3 of 1%. Yields lower at the long end by 7 basis points on a 10-year. So 2s, 10s inverts for the first time since 2019 in the UK on a gilt curve. From New York, still more to come. Lee Ferridge in the next hour from State Street Global. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China has begun military drills around Taiwan in response to House Speaker Nancy Pelosi's visit there. One of the exercises involved missiles being fired into the sea. Taiwan is downplaying the effects of the drills on shipping and airplane routes. There will be another attempt to save the landmark Iran nuclear deal. Diplomats from Iran, the US and Europe will meet again in Vienna after months of deadlock. The accord fell apart after Donald Trump withdrew 4 years ago and reimposed sanctions on the Iranian economy. That led Iran to step up enrichment of uranium. The US Senate has voted overwhelmingly to add Finland and Sweden to NATO. It's a move aimed at bolstering the military alliance after Russia's invasion of Ukraine. Turkey is still threatening to block the two countries from joining. Credit Suisse is considering thousands of job cuts worldwide in an attempt to cut costs by an additional $1 billion. Bloomberg's learned that the Swiss bank is weighing an aggressive plan to reduce headcount. Credit Suisse has more than 51,000 employees. It's trying to move back to profitability after losses and scandals. And shares of Alibaba are rising in pre-market trading. The Chinese e-commerce giant posted second quarter net income and revenue that were better than expected. Alibaba's cloud and media sales missed estimates, whilst sales at the China commerce segment shrank for the first time. The company says it saw signs of recovery in June. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We only have about a 5 to 10% risk max that the Chinese and the U.S. will come to blows militarily. And if it happened, it would probably be inadvertent. We don't think Beijing or Washington want to have a military conflict here, any kind of an incident.
Robert McNally there on the situation over in China and beyond. From New York City this morning, good morning. Tom Keene, Lisa Abramowicz and Jonathan Ferro. Futures positive 0.2 on the S&P. The rally continues on the NASDAQ, up around about a quarter, call it a third of 1% higher. Yields a little bit higher on a US 10-year, a Treasury, by a basis point to 271.18. They are lower on a British 10-year. A gilt 10-year yield, lower, much lower. Look at this for a forecast. Can you imagine? You've got to hike 50 basis points. You're forecasting inflation to hit 13% and recession to start at the end of the year, Tom. That was the Bank of England 20 minutes ago.
We've certainly never seen that from the Fed. I mean, it's absolutely original. John, place in context right now how the two candidates will adapt and adjust to what we saw at 7:00. What will Truss and Sunak listen for in the press conference?
There is going to be a ton of pressure now, Tom, for them to do more on the fiscal side. And ultimately, that's what they're trying to do, if you're Liz Truss. Rishi Sunak, the former Chancellor, is essentially saying we've got to get the finances in order first. And ultimately, Tom, the more they do perhaps on the fiscal side, the more the Bank of England might have to lean in too, given what could happen with inflation. And this is what Lizzie Burden said at the top of the programme as we broke down this decision. It's very hard to understand these forecasts without really knowing, Tom, what the fiscal picture will look like. Down in London and Westminster.
To our American audience on radio and TV, I really can't convey the differences here. The similarities are way overrated. There are differences and similarities with China and Washington. Jack Fitzpatrick joins, picking up the pieces on a Thursday after an historic week, and the week is not ended. Jack, I've taken a lot of solace from Foreign Affairs magazine. Richard Haas and David Sachs lead there with the response that we must have that is unambiguous. What clarity should we listen for from President Biden?
As it relates to the recent Taiwan trip in China, I think that there's been a lot of ambiguity, and the White House may even be leaning in a bit to some ambiguity because on one hand, you have the Speaker of the House visiting Taiwan despite warnings from the Chinese government. And yes, the U.S. has a close relationship with Taiwan, but you see, for example, the White House pushing back a bit, at least on the timing of a bill that was supposed to come up to formally treat Taiwan as a non-NATO ally. The Biden administration has said openly that the military had some concerns about Pelosi making this trip. They aren't going to openly fight her on that, but there is quite a bit of ambiguity, and it has put President Biden in a position where he wants to have communication with the Chinese side, but not entirely try to back off of the relationship with Taiwan.
Should we expect an announcement from Washington and Beijing over a meeting of the two parties?
I don't know about an announcement on a meeting of the two parties. There was the phone call recently, and obviously the White House doesn't want to cut off communications with the Chinese government. We'll have to see where the White House goes in the future, but they've made it a priority to have direct communication between President Biden and Xi Jinping, and have felt that's particularly important given the tension with Speaker Pelosi's visit.
It's a difficult time for President Biden's camp, especially because of all of the other issues domestically that are facing and what's coming down the pike. I'm wondering about what you're hearing about messaging ahead of tomorrow's jobs report. If it's strong, great, the economy is doing well, but not so great because that means the Fed will have to do more weakening, and all of a sudden people accuse President Biden of overseeing an economy heading for recession. How are they trying to get ahead of that?
Well, either way, the White House is not trying to message in a way on the economy that takes for granted some level of success on the economy. They've really lately been focused on acknowledging concerns about inflation. You see essentially the rebranding of their legislative proposals, or what they could get into the Inflation Reduction Act, as they're calling it, trying to focus on deficit reduction issues. So they, even if the news is good, they're not exactly taking a victory lap on the economy. The president is talking about what he's trying to do with members of Congress to address inflation, and it's much more of a tone of conceding that there are significant issues, that this is not an economy that's going to be a huge success electorally for the Democrats in the midterms, but trying to make the case that they're doing what they can about it.
Hey, Jack, awesome to catch up. Jack Fitzpatrick there of Bloomberg Government down in Washington, D.C. Lisa, it's never easy, is it? It's never easy to get a bill together and get everyone on board.
Especially now when you have that much splintering within each party, let alone the dual parties. How much do you get people coalescing around a deal that really came together shockingly quickly and shockingly quietly, if you think about it? This is the stripped down, Build Back Better, rebranded as the Inflation Relief Act of 2022 that they're trying to push through.
Does it actually reduce inflation? And that's something we can talk about another time. Tom, no room for error, no space for error at all in that Senate for these Democrats.
Well, that's true. And again, this goes back to the heart of the matter, which is a victory that we saw in, 2020. And it's been a struggle the entire way and still continues to be a struggle domestically. And as we were talking to Jack there, John, I'm fascinated about the cohesive message to China into Q4. That doesn't even mention the COVID debate, which is still very tangible.
That's the number one debate, Tom. COVID zero. Paul Sankey talked about it moments ago, about an hour ago on this program. Lisa, can you have a complete picture of the oil market next year without understanding whether we've got COVID zero in China, lockdown, lock off? What is it?
Can you have a coherent understanding of the global economy, of trade? And we get those trade numbers at 8:30 in about an hour from the United States. Can you get any picture without understanding China's zero COVID policy, particularly with the energy market? And then how does this factor in to where the U.S. sees its leverage at a time of ratcheting up conflict between the U.S. and China?
I mean, John, I'm going to go back to your relationship on one of your other properties with Jay Pulaski. He won't get up early enough to talk to us. He will talk to you at a later decent morning hour, and it's about a Pacific Rim recovery. And the JP Morgan oil call folds right into a demand recovery off of emerging markets in Pacific Rim. It's not happening.
It's kind of just to say that Jay only comes on because he likes to sleep longer, Tom.
That is. It's like same with
Mohammed.
Mohammed.
What a great compliment to my team.
You know, Hilarian's the same thing.
Mohammed likes to sleep in too. That's the only reason he comes on with me as well.
Yeah.
Thanks. I appreciate that.
Things are great between you guys this morning.
No love lost today, hey?
I'm going to call Dr. Phil. I think he
I'm still
can
reeling
join.
from these forecasts over on Threadneedle Street at the Bank of England.
Truly stunning.
Recessions in the forecast for 4Q, 13% CPI. Brutal, Tom, brutal.
What about sterling?
In the face of so much doubt, what a rally we've seen on the S&P, on the Nasdaq since the June 16th low. On the Nasdaq 100, up more than 19%. On the S&P 500, up more than 13%. Right now, futures positive by a little more than 1/10% on the S&P. On the Nasdaq 100, up around 0.2%. You saw the bond market yesterday, how it responded to the Fed speak. Yields higher at the front end, but a drop at the long end. And the curve inversion, 2s versus 10s, getting close to negative 40 basis points at one point this morning. Right now, yields up again by 3 basis points on a 10-year, up only a basis point or so on a 10-year. So again, a little bit more curve flattening, a little bit more inversion. In the UK, about 30 minutes ago.
The hands again, John. The hands is very good.
That's the Tom Cruise thing.
On radio, it was
Mission
great.
Impossible, the inversion thing anyway.
You look like you're landing an airplane.
Can I do the UK thing first?
Please.
Tom? We got some inversion briefly for a moment on 2s versus 10s. On the gilt curve. About 30 minutes ago, off the back of the Bank of England rate decision, the Y got a 50 basis point hike, and the Bank of England forecasting a recession in Q4 that lasts the whole of 2023. Tom, throw in 13% CPI, stir it up, and what have you got? pretty brutal.
Do you have John Major? John, with all your perspective at Warwick and history, are we reduxing 91 into 92?
We will find out what the fiscal response will be from the next Prime Minister, which we expect it will be Liz Truss, Tom, based on the betting at the moment and where things are leaning. And if it's Liz Truss and she does more, Tom, I just wonder where that leaves the Bank of England. Do they have to do more? And Tom, you know what came after Major? Ultimately, what we got in Gordon Brown and Tony Blair was an independent central bank. Since we had an independent central bank,
there you go.
This is the biggest hike since then.
See, folks, that's your value add on surveillance.
That's your lot. You should just turn down a radio, change the channel and move on, because from here, downhill. In fact, from here it gets better because Lisa speaks and Tom and I stop talking. Futures, positive. Let's get some stocks. Here's Bramo. Hey, Lisa.
Hey, I hope I can deliver on that. There are a lot of really interesting stories that go beyond the macro, and there are these micro currents. Alibaba among them, American depository receipts up almost 5% after being down about 20% year to date. They beat expectations just in their earnings, despite all of the headwinds, despite the zero COVID policy, despite regulatory oversight and crackdowns by the authorities there. Taiwan Semiconductor, I'm watching closely, up about 0.8% after we talked about Nancy Pelosi visiting the island and meeting actually with executives from the Taiwan Semiconductor Company, which is such a pivotal node in the entire global ecosystem, considering how much of our world depends on chips, that they are the major provider of them. Lyft, I'm watching closely. Those shares down about 60% year to date. They're up about 0.8%. They're reporting after the bell. Some of the other stories that are less positive today, based on some of the earnings outlooks. Clorox came out, disappointing earnings, down about 6% ahead of the open. This is a story about supply chains. It is more vulnerable to them at a time when people are demanding prices not rise that much. You are getting consumer pushback to some of the price increases. Eli Lilly came out. They talked about headwinds from the FX currents, about $400 million off their top line based on that. Those shares down about 3%. And then Lucid Group, poised to report earnings. They were talking about the forecast going forward. They halved their output expectations for 2022. The electric vehicle maker already down sharply year to date, down about 13% now ahead of the market. And Tom, the reason why these kinds of stories are interesting is because some stocks were bid up so dramatically after the pandemic or during the pandemic have come full circle. We have seen completely the wind knocked out of so many companies with most of the value taken out. And that is underpinning some of the ballasts of the market that have held in much better.
Futures up 8, the VIX under a stunning 22. 21.88 is really quite something here. Less than an hour from jobless claims. This is a joy right now to be briefed in the chaos of this early August. Ed Al-Husseini joins us to say senior interest rate strategist at Columbia Threadneedle barely describes the legit EM World Bank IMF cred that he brings. This out of Colgate University and a small college in Cambridge as well. Good morning. I want to go to your real job before you got this act at Columbia Threadneedle, which is at Moody's. You actually sat at a desk and rated EM. Are we heading towards what you and I studied in history of EM next year in 2023? How fragile is EM?
Yeah, it's a good question. I think there's a really long tail in emerging markets that is in distress, and we're seeing that in South Asia. We're seeing that in sub-Saharan Africa. The good news is the core of EM, the emerging markets that went through those crises in the 2000s, in the 90s, they've built up much better buffers.
They've got better practices now.
They've got better practice, better policy.
I look at this, let's bring it over to developed country, and the headline here, John's been wonderful on it, is the shock and awe of 13.2% inflation. Can you explain to me almost the first derivative of the x-axis we're all going to live on this inflation battle? We're all thinking short-term quarters and that it's a media thing. Are you looking at 1, 2, and 3 years for inflation to come in?
I think that's right. If you think about the challenge for central banks, I mean, both the Fed and the Bank of England is, of course, in a much more difficult spot, is the ability to build confidence that inflation will go back down to 2% over the next several years is exceptionally low right now. So what happens to the data over the next several quarters, in some ways, is a lot less important than those central banks' ability to be confident that they've tipped inflation over on a trajectory down to 2%. It's very, very difficult to get to that spot at this stage.
Ed, we were talking earlier this morning with the Bank of England. They came out and they project a recession that is long, that is painful, at the same time that they're raising rates. Could the Fed ever do that?
I think the answer's got to be yes. They're definitely committed to their credibility. They're committed to reestablishing credibility with respect to the 2% target, and they're in a corner where they essentially must hike and must tighten policy if they don't see inflation coming down to 2%. So there's very little reason to doubt them at this stage.
So what's the market getting wrong? Because the market seems to be thinking the Fed will be able to move away from some of their rate hiking sooner than previously thought, even with the recent repricing, because there is this entrenched belief that inflation will come down in the next couple of quarters.
It's probably a decent bet that inflation will come down. It's not clear if it will come down to 2%, and that's the key benchmark. If you look at market pricing, markets are priced for about 100 basis points of tightening over the next 4 to 5 meetings. That's an exceptionally narrow room for the Fed to maneuver. And so if anything, you're starting to see the Fed come out and start to push back a little bit against that, just to create space for them to maneuver if data surprises them again in the course of the next couple of quarters.
I guess I'm trying to understand some of the movements in the market because, yes, you have seen people expecting inflation to roll over, perhaps not as much as the biggest optimists. You're also seeing credit rally at a dramatic pace. You're seeing people pile in at a time when there is the expectation that at some point there will be a downturn, if not an outright recession. Does this seem like a faulty bet or one that's worth piling into based on how high yields got?
It's tricky because I think two things are true. First, if you look at growth and growth expectations, you can probably make the case that perhaps they got too negative in the course of the past couple of months. So we've hit a little bit of a floor in terms of growth. Data has surprised marginally to the upside since then. And so you see that kind of a relief rally in credit and risk more broadly. At the same time, it's clear that the Fed is not done. Tighter financial conditions are essentially a precondition for inflation coming down to 2%. So the foundation for the risk rally is, I would say, quite thin.
I want to go to Benjamin Friedman. I want to take the synthesis of all your academics and the work you did at Harvard and the great, great Benjamin Friedman in his worry about sustained growth. In the jumble that we're in 2022, is global growth at risk? Is this modern experiment of 6% China, decent growth in America, all the turmoil about inflation and that? Is growth finally at risk?
I think it's a really good question. If you look at what's happening on the demographic side, we've been slowing progressively, really over the course of the past several decades. China's population is set to slow. Birth rates in the U.S. are exceptionally low.
But what about the technological overlay?
The productivity is the key question. If you look at productivity of the last several years, it's been very disappointing. Productivity growth over the last several years is flat to negative this year. So unless there's a recovery in productivity, which is a significant question mark, I think long-run growth is likely to perhaps take a step down. And again, from an interest rate perspective, it creates a challenging environment because it's becoming more likely that interest rates go back to that secular stagnation, low demand, high savings place yet again once we're through this inflation window.
I just want to get that in, John, for our August gloom theme, August doubt theme.
Is that what it is, Tom?
That was it. You were just
Tons
trying
of
to
gloom.
maintain the theme.
Just climbing the wall of doubt.
He's
right
got
now.
some
We
real
continue to.
authority there, seriously.
Ed does,
Yeah.
without a doubt. Ed, thank you. Ed Al-Husseini there of Columbia Threadneedle Investments. Just a mention of high yield. In a month, we've tightened 140 basis points, Lisa, in a single month.
Wow.
Typically, you'd think that happens after the Fed has made a major pivot. They have not made a major pivot, in the words of the central bank speakers themselves.
Yeah, I was actually speaking with Howard Marks of Oaktree about this, and he was, before that rally, thought that there was a good buy, and after that rally said the risk-reward is pretty evenly balanced at this point. I mean, it's completely repriced things, and you've seen people respond and companies respond by selling a whole load of debt because get in while you can, right? And that's certainly what we're seeing right now.
I love how careful Howard is with his words. The risk-reward. What did he say? The risk-reward what?
Well, you basically was saying that it seems like a balanced risk.
Okay.
And it seemed like it was a less balanced risk to the upside before that.
There you go, Tom.
He never comes on with us
some
either.
serious spread tightening.
John,
Are you suggesting that he likes to sleep in too, Tom?
Yeah, we got to get Mr. Marks in here.
Is this your excuse for why people don't want to talk to you?
Yeah.
They want to stay in bed?
We could get Mohammed and Howard on together. That would be great.
That would be very cool.
Bring Ed Al-Husseini along. It'd be great.
That would be very cool.
All of us at a big table,
Yeah. In the same room?
Yeah.
That would be nice.
Over in Cambridge, road trip. Go see Mohammed.
You think Mohammed's got Tang?
I love this.
No, I don't.
How did you get a road trip in here?
Never say it is the
Every
university.
single opportunity.
I know,
It's a
it's
road
not even-
trip.
it's not even an
That's right,
opportunity.
Tom. That's right. We'd be in a different time zone. That would change everything.
It would.
Then all these people would come on with you.
They would.
Futures on the S&P up
Move the
0.2
show to
of
London.
1%. I'm on board with that, Tom.
Really?
Just for a quarter or for the year?
Oh no, move.
Oh, no,
like
for good.
move.
Move.
Take
Move.
vet bill.
Okay.
Take kennel fee.
That's
You
how the
know,
kids-
move.
We're gone. Okay. All right. At least it's got to talk to her sons about that. See what they say.
Sure.
They're ready to go. Okay. All right. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. In the UK, Foreign Secretary Liz Truss has rebounded from an embarrassing policy U-turn to regain the momentum in the race to become Prime Minister. Truss is just receiving the backing of former Chancellor Sajid Javid. That's a blow to her rival Rishi Sunak. Javid wrote in the Times newspaper that Truss would challenge the status quo and deliver immediate tax cuts. Wall Street CEOs don't want to spend any time in quarantine if they attend a Hong Kong conference in November. The conference is designed to advertise the financial hub's revival after more than 2 years of COVID restrictions. The CEOs of Morgan Stanley, Goldman Sachs and UBS are amongst those invited. Their banks want a guarantee of quarantine-free travel. And investment banking bonuses on Wall Street are likely to plunge this year, according to compensation consultant Johnson Associates. Incentive pay for those underwriting debt and equity could plunge more than 45%. Those advising on mergers and acquisitions could see their bonuses fall by 1/4. At the 5 largest Wall Street firms, investment banking revenue fell 43% in the first 6 months of the year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I think that the big issue we have in the market is that the Fed is not about to pivot. And it's the same issue we have for many central banks around the world, right? Inflation is so high that it's just too early for central banks to come out and explicitly signal something new.
Into Nordvik there, Vexante data. We're getting something new from the Bank of England, a 50 basis point hike. We haven't seen one of them for 27 years. Futures right now on the S&P are up a little more than 1/10%. The Nasdaq still rallying, up 0.2%. Your euro unchanged, 101.69.
Yeah, look at sterling.
Yields up a basis point, 270.137. We can look at sterling right now, Tom. Negative 0.5 basis point on cable. Sterling against the US dollar, 120.85. Wow. They are forecasting a recession. They're forecasting CPI 13% at its peak, Tom. And this is going to get really, really messy and difficult for the British consumer, that's for sure.
Let's get right to it. Our conversation of the day on the United Kingdom with David Blanchflower, professor of economics at Dartmouth College. He darkened the door at the Bank of England a number of years ago. We're thrilled he could join us today. Danny, you've gone through the details, and you make it very clear that a la 1947, in a path to the Eisenhower deflation, the inflation panic is overwrought. This is a bank signaling a deflation or a substantial disinflation out to 2024. What should be policy if we model a future disinflation?
Well, obviously, the story is the forecast of a recession. 6 quarters of negative growth they're forecasting. But if you go to I think it's their chart 1.4, and what you see there is that there's a significant risk in 2024 of deflation. And there's the famous chart the Bank of England produces, shows you 800 years of inflation. And the one thing that stands out from it is the big risk when you have high inflation is that you generate deflation. And so that's obviously the worry. I mean, the truth is, John is right. They're forecasting 13% inflation pretty soon this year. But by 2024, this thing plummets. And I think the likelihood is actually that this forecast is overly optimistic. I think the chances are the unemployment rate is going to rise by much more. Output is probably, I mean, it may not last for 6 quarters, but output probably is going to be weaker, and we're probably going to see the bank having to U-turn pretty fast. I mean, this is a devastating, terrible forecast. I'm sorry, last point. I remember in 2008 in August, so a number of reports ago, and the big deal then was the UK was in recession, and they didn't use the word recession. The word recession is all over this report. So this is devastating. But I think the argument that balance of risks is balanced, Lisa just talked about it, risks are actually very strongly to the downside to this. So why they actually raise rates, sort of unclear when you read the thing.
Well, Danny, let's talk about how original this moment truly is. And can you imagine the Federal Reserve forecasting a recession in the way that the Bank of England has done today? And why do you think that's the case?
Well, I think in some ways they're under huge political pressure to try and deal with the interest rate, with the inflation rate story. I mean, Truss came out this morning and said the bank should have raised rates earlier, and we're going to relook at the remit. So I think the politics of it are pretty interesting. I mean, the fact that the word recession is in this report. I don't know of any other monetary policy report that has that word. As I said, go back to the August 2008. They didn't even use the word recession when they were in recession. So obviously some of the question is, how quickly does recession come, and how quickly does the bad data come? But we've got bad PMIs this morning, sales of UK cars down 11%. I mean, this baby could get bad pretty quickly. And I think, as you say, the likelihood of the Fed doing this is really pretty different. But I think this is pretty unique for the MPC. I've not seen anything like this in all my time with the Bank of England watching.
When you're talking about the balance of risks and how it's incredibly skewed to the downside, how do you then respond to Jordan Rochester's point about a wage spiral that you're actually starting to see in a very real way, and how this bank gets ahead of that to curtail that, even if it requires some sort of recession or significant downside in the near term?
Well, we've been talking about non-existent wage spiral since 2008, which we haven't seen. I mean, we've seen some attempt to try and keep up nominal wage growth. We've seen big falls in real wages. I think the idea of a wage price spiral in the United States and in the UK is for the birds. I mean, we're seeing settlements around 4%. We're seeing public sector workers saying, we need to try and maintain our living standards. The chance that any of this is driven by workers demanding and getting higher wage increases, I see absolutely none of that. None of it in the United States, none of it in Europe, none of it in the UK. We're talking about 13% inflation and workers asking for 4% pay raises. This is not driven, none of this is driven by wages. So I think that whole argument is just nonsense.
Danny, a lot of people are saying that right now this is the Bank of England front-loading rate hikes, that they're going to start cutting rates, or at least pausing the rate hikes later this year, then cutting next year. And that seems to be this belief with the Fed as well, that yes, there are some pretty significant rate hikes, but it is a front-loading to try to get ahead of the inflationary push. Why do you think that's a bad idea, to see what you can do now and then wait and then see how it trickles out?
Lisa, it's a great point. But I mean, I always had the view that you say what we need to do is get rates up to try and cut them later from the recession that you've caused. So obviously that seems like a problem. I mean, the bigger issue in some sense, Lisa, is that, yes, you've now got rates up. We're talking globally around 2 or something, less in the euro area. The problem actually is, think back to 2008, we could cut from 5% to a half or 0. The room for the central bank to cut is limited. It's going to fall on fiscal authorities. Look in the UK. There's basically no prime minister. There's no chancellor of the exchequer. People are talking about the plans that they might have, but the pressure is going to come on a new chancellor and a new prime minister pretty darn quickly, and the markets are going to speak, and they're going to say whether they think this is appropriate or not. I mean, we don't even know who the chancellor would be in September when these bad data come in. So I agree with you, but it looks to me that you front load interest rate rises for the recession that you worsened by doing it. So I think there was a significant argument today to actually sit pat and wait, because it's unclear that these rate rises are going to do anything to bring inflation down, being caused by global oil prices. How is these interest rates actually going to do anything other than tank the economy? How do they actually bring prices down? And Bailey's already admitted that basically it can't. So I think there was a strong argument to sit, wait, and watch. But the political argument was a very strong one because the trust was threatening the remit of the banks, and they should have raised rates earlier.
Well, I'm not surprised you said that at the end there, Danny. That's for sure. Danny Blanchflower. Danny, always good to catch up from Dartmouth College. Governor Bailey saying this moments ago, our forecasts are, quote, exceptionally large. The risks around them. The risks around our forecasts are, quote, exceptionally large, Tom. And I think that probably holds true for most forecasts looking out anything beyond 3 months at the moment.
I was going to say 3 weeks. I mean, can we get to the November Fed meeting? I don't think so. Not a chance. We have to focus on the data, including August 10th, John, to September.
Inflation data next week here in the United States with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures are up 0.1% from New York City. This is Bloomberg.
The market is kind of looking through what the Fed and other central banks are saying right now.
I think the Fed's been trying to reset and say, hey guys, we didn't really pivot. You may have thought that, but we didn't do it.
It is possible to cool the labor market and cool the economy without seeing a real large increase in unemployment rate.
We're going to be disinflation. We're going to go through disinflation in the future. Now, I can't tell you when it's going to happen.
We wouldn't be particularly aggressive at this point, and we're just suggesting patience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. A most momentous Thursday into the jobs report tomorrow. Claims in this hour, but all eyes on the United Kingdom. There's no other way to put it, John. History made this morning as Governor Bailey speaks now.
What an original moment, Tom, to see a central bank forecast a recession that starts in 4Q and goes through the whole of next year, together with 13% inflation and a 50 basis point rate hike. That's a pretty original moment, Tom.
27 years back, I go back to 1995, John. You remember it, John Major as prime minister, coming off the 1992 chaos. John, that was when Arsenal, they acquired Inter Milan's Dennis Bergkamp. That was really something to see.
How do you remember that? I don't
remember it,
that.
but I looked it up because I remember there was this incredible trade between Inter Milan and Arsenal back then. But it harkens back, John, seriously, not to the success he had at Arsenal, but I'm only doing this for Kit Jukes.
Sure.
The reason, John, is it harkens back to that early 90s uncertainty. Do you sense that uncertainty now in your England?
Without a doubt. And Tom, I'd go further. You have to recognize this is the biggest rate hike from this central bank since it became independent. And independence of the Bank of England, Tom, isn't that old? It's the late 90s.
Yes.
I think people forget that. And Tom, you remember the story of the last 10 years. We were talking about this independent central bank story, how credible they've been at keeping inflation down. That's changed over the last year. And there's some political pressure building on both the Bank of England and, for that matter, this Federal Reserve too.
And John, moments ago, this is the headline we've been waiting for. The governor saying not for the independent Bank of England to get involved in leadership election. Baloney. They did this morning.
And Tom, we'll find out if it is Liz Truss, and if it is Liz Truss, whether she comes out with a bigger fiscal package. That's what this market at the moment is very focused on when it comes to the UK. How big is the fiscal effort, and what does that mean for the Bank of England offset that might come down the road?
Sterling weaker here, 120.85. When we go to the bond market, Lisa Abramowicz, it's real simple. Fixed income speaks.
Fixed income is speaking, and it's not speaking in a very nice way. And honestly, stocks have taken notice as well. You've seen a lot of the gains in the early morning fade substantially. They're coming back a little bit, but it basically was a flat tape just moments ago. Bond yields coming down. How much is this in anticipation of the weakness that people are expecting from the moves that the central banks are going to make? And I look at the curve inversion, which is 37 basis points. In other words, the 2-year yield was 37 basis points above the 10-year yield just moments ago, at a time when people look at that as a recession signal, and it really is flashing some red signs.
We're going to have to see. Let's get to the data right away. We've got so much to talk about here this morning. John, I'm going to go to the continued equity lift that we see. It's somewhat off the radar given the macro news, but nevertheless a resiliency indicated by the VIX. 21.99.
What a rally we've had, up 19% from the lows on the Nasdaq 100, up 13% from the June lows on the S&P 500, and futures go again by about 0.1%. Yields unchanged on a 10-year, 269.91, with sub 270 on a 10-year. We add a little bit more weight onto the 2-year over the last couple of days, just a ton of hawkish Fed speak, disrupting the bond market, and as Lisa said many times over the last couple of days, doing very little to disrupt the flow into the equity market. On the Bank of England, Mohammed Al-Arian just out on Twitter writing this, Tom. The Bank of England continuing, quote, with what has been the most direct and honest commentary of any major central bank.
No question about that.
We have not heard this kind of commentary from anybody, Tom, in a central bank about how dire they think this outlook is.
And someone with that perspective, Lee Ferridge joins us now, head of macro strategy for North America at State Street Global Markets with decades of experience. Lee, I'm going to cut to the American chase for those on radio and TV. Can the angst of Governor Bailey migrate across the Atlantic and become the angst of Chairman Powell?
Oh, I think almost certainly. I mean, you know, as you just mentioned, I mean, the Bank of England is being the most honest of the central banks. They're predicting a recession that will last for 5 quarters, so a prolonged recession, and yet they feel the need to hike by 50 basis points with more to come. That's the reality facing the central banks. And the Fed is still, oh, we can avoid recession. We think we won't actually hit recession, a slowdown, but no recession. Come on, we're going to go into recession. Major economies are going to go into recession. If we're going to target inflation, we're going to bring inflation down. The squeeze on the consumer is significant. We're going into recession.
So why is consumer discretionary rallying this hard? This rally off the lows in June, Lee, is something else. It's up more than 20% on consumer discretionary on the S&P. Why?
Well, you've got a big split. I mean, as ever, you have a big split between sort of, you know, income levels. So lower income levels are really, really struggling with this increase in inflation. You know, a large proportion of their spending goes on food and energy, which is, you know, the heart of much of the inflationary pressure. Consumer discretionary, if you're the higher end of the income spectrum, there's still savings. There's still excess savings from the pandemic, and those are now being spent. So consumer discretionary is more that sort of higher end. Consumer staples is that sort of, that lower income end. And that's why you're seeing that divergence there.
Lee, have you already seen it priced in terms of the recession that people are predicting? And is the consumer discretionary perhaps responding to the other side of this cycle because people have gotten that far ahead?
Lisa, I don't think we're pricing in the recession that's coming. I mean, I think it's not going to be a deep recession in the same way as, the financial crisis. But it's going to be prolonged. The Bank of England have told us that this morning, right? It's going to be a prolonged recession. This idea, we could have a technical recession, maybe a quarter or two. No, this could be a more drawn out, prolonged recession. I don't think that's priced in. So I think that's the divergence here. And you say, the massive rally we've seen over the last few weeks or so, that's not reflecting that risk. That's reflecting this soft landing. We've taken out the peak for Fed rate hikes. We're sort of looking at, okay, so, that does the slowdown in growth, does the job for the Fed. They don't need to hike as far. We have this little slowdown and off we go. It's cloud cuckoo land. That's not the way this is going to play out. It's going to be a much more prolonged recession than that.
So, Lee, as you've adjusted your view to become much more negative, how have you changed your allocations at a time when many people see the haven as still being longer-term U.S. bonds?
I think it still is. I mean, I think still. I mean, this is why the curve's inverted. I mean, you look at how inverted the curve is, as you mentioned, the most inverted since 2000. So forget the financial crisis, forget the pandemic. This is the most inverted since 2000. And that's the allocation. You want to be at the longer end. And then in terms of FX, it's the dollar. And this is why the dollar keeps rallying. The dollar's bounced, dollar weakened a little bit over the last few weeks, but it's coming back hard again now. And the Fed message is going to be clear, and that's going to lead to more dollar buying as well.
Lee, our audience has heard the same thing repeatedly over the last several weeks, and repeatedly we keep adding more weight to this rally. Lee, earlier this morning, Matt Kettner of HSBC put out a note, and he's with you. He's calling this dreamland, says it's wishful thinking. At the end, though, he goes through the risk factors around the view. What if we're wrong? Lee, what if you're wrong? What's the big risk factor around your view and whether this rally can continue?
The biggest risk factor around the negative view is actually that, and it would be a very positive development, and that is that the conflict in Ukraine comes to a rapid end. that leads to, reduction in the sanctions quite quickly, and therefore the inflationary pressures. We can all revise down our inflation forecast. We can revise down what we expect from the central banks. That would be the risk to the view. If it doesn't end soon, it's really hard to see how central banks are going to back off, how the data is going to get better. Look, we've had this from the Bank of England. I think this is a real bellwether moment with the first central bank really predicting a prolonged recession and saying, that's the way it's going to be. We're still hiking 50 basis points. I think that's a bellwether moment.
Hey, Lee, great to catch up. An important moment for sure for that central bank. Lee Ferridge there of State Street Global Markets. I mentioned Max Kettner over at HSBC. Here's the quote. For this buy anything rally to continue, we need to see further repricing of rate hike expectations and another sharp drop in real yields. Goes on to say, but market pricing of risk assets is now very much out of line with our cyclical growth indicators. You guys have all heard that a million times. This is the conclusion. Where could we be wrong? If inflation does indeed surprise to the downside or growth stabilizes much more quickly, Tom, than we thought, then the recent rally in growth over value could continue. It continues just a little bit this morning.
The separation here, John, is like the Dallas trim mean of earlier this week, which was really quite inflammatory, or certainly what we've seen from Governor Bailey as he frames out the United Kingdom, versus those that see the goods disinflation, service sector maybe becoming quiescent, and then you easily get from, say, 9% down to 7% or 6%. The then what, to me, is a complete mystery.
So the thing I think about as I'm going through all these notes in the evening at the moment is just, Lisa, what if Marco's right? Marco Kolanovic over at JP Morgan, and what if this just continues? BNP Paribas put out an interesting note this week, and they talked about the crowding in effect. And we all know the biggest determinant of sentiment sometimes is just price. And price is changing pretty quickly. And I wonder if BNP has a point when it comes to crowding in.
And especially because if you take a look at the savings rate and you look at it across the income spectrum, at the upper ends, it still is very significant. There are a lot of people still with a lot of money who are getting pay raises and they don't know where to put it. And so where are they going to go if not just into the market? And you do see companies that are delivering on their revenues and are still growing. So at what point does that become a haven, especially in light of the inflation that might really affect some of the bonds that people are going to for safety?
John, you're going through your notes in the evening?
In the evening, what do you do?
I was watching Padres last night.
9-1,
5 in a row.
Someone's got to read.
I'm reading.
Lita does a bit of your reading. I do a bit of your reading.
Exciting.
We put it together.
You know, it's just great.
You get to watch the baseball. Tom, is 8
No, it's not
a.m.
the
in the
baseball.
morning?
It's the Padres.
Is 8 a.m. in the morning late enough for great guests to come on this show? Are they out of bed at this point?
Yeah,
Probably, right?
Probably entrepreneurial guys buying airline leasing companies, sure.
Someone like Jim Zelter.
That would be good.
The co-president at Apollo. He's going to join us next.
He bought a 747 today.
I think they did something in aviation that we can talk about, Tom.
He owns, it's not every day you buy a 747.
You can talk to him about it. Tom Keene, Lisa Abramowicz, and Jonathan
Metallica
Ferro.
or something.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A warning today from the Bank of England. It raised interest rates by the most since 1995 and said the UK is heading for more than a year of recession. BOE policymakers say the recession will begin in the fourth quarter, and they estimate that inflation may peak in October at 13.3%. China has begun military drills around Taiwan in response to House Speaker Nancy Pelosi's visit there. One of the exercises involved missiles being fired into the sea. Taiwan is downplaying the effects of the drills on shipping and airplane routes. In Russia, a prosecutor has asked for a 9.5-year prison sentence for American basketball star Brittany Griner. Closing arguments are taking place today. She has admitted having vape cartridges with cannabis oil in her luggage. There have been talks between the US and Russia about a prisoner swap. Investment banking bonuses on Wall Street are likely to plunge this year, according to compensation consultant Johnson Associates. Incentive pay for those underwriting debt and equity could plunge more than 45%. Those advising on mergers and acquisitions could see their bonuses fall by 1/4. At the 5 largest Wall Street firms, investment banking revenue fell some 43% in the first 6 months of the year. And shares of Alibaba are rising in pre-market trade. The Chinese e-commerce giant posted second quarter net income and revenue that were better than expected. Alibaba's cloud and media sales missed estimates, while sales at the China commerce segment shrank for the first time. The company says it saw signs of recovery, though, in June. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft,
with exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio, the fastest numbers and analysis you trust.
Some financial markets are indicating that they expect us to cut interest rates next year. I don't want to say it's impossible, but it seems like that's a very unlikely scenario right now, given what I know about the underlying inflation dynamics. A more likely scenario is we would continue raising, and then we would sit there.
The central bank that doesn't want to offer forward guidance spent a lot of time yesterday offering forward guidance. Neil Kashkari of the Minneapolis Fed just yesterday, together with basically everyone else under the sun who works at the Fed. Futures positive 0.06% on the S&P 500 this morning. Good morning to you all with Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures up a tenth on the Nasdaq too. TK yields come in a couple of basis points. We back away on 10s to 268 on a 10-year yield.
Sterling 120.80 off Bank of England, John. Still extraordinary, weaker sterling this morning.
Unbelievable. Down 0.6%, Tom, off the back of a 50 basis point hike, a forecast for a recession, and 13% CPI. Is that enough for you?
It's very good. I
Ugly.
like that. Let's go. Yeah, very good. What we've got here is earnings, but nobody cares, because when you do a transaction of this import and symbolism to Wall Street, and frankly, a recovering world from the pandemic, it is good to talk to Jim Zelter. He's co-president of Apollo Asset Management. And yeah, on earnings, but I'm going to go beyond earnings, Jim, to your new transaction acquiring the leasing efforts of the largest fleet of 747s in the world. This is the cargo business mostly of Atlas Air. How do you dive into such a troubled industry? Is COVID, Asia, moving cargo, and say the opportunity is now?
Well, good morning. Thanks for having me on. That's a classic Apollo transaction. We know the industry well. We've been around it for decades. We've successfully navigated it, no pun intended, in terms of a variety of other investments in the space. And it's a classic opportunity for us to use our great industry skills, our great capital formation skills, and do something we think has got a lot of fundamental value where purchase price matters. So, a lot to talk about Apollo today. That's one transaction. But very, very happy with what we've done in that situation.
Well, let's talk about the inflows. 36 billion, I think 13 billion after quarter end in a first close of your next flagship PE fund. Just going through some of these numbers. Jim, as you look at the opportunities in front of you, where are they? What can you do that the banks can't do that you're excited about?
Well, listen, as you said, Jonathan, it's a very foggy environment out there. A lot of dispersion on views on where rates and other things are going. And that's when we do well. Record FRE for us for the quarter, record SRE. Capital formation, deployment, origination strong. For us, it was a great quarter in terms of, investor dialogue. As you said, 36 billion in the quarter. We closed 13 billion on our new flagship fund 10. And for us, this is the kind of markets that we thrive. When others are a bit paralyzed or markets are closed, we bring our flexible capital, our permanent capital, our ingenuity to transactions. And, I know you mentioned the Atlas Air, but for us, New Fortress Energy was a great transaction. Air France, in New Fortress Energy, basically we've been with this company for a couple of years. We've been a financing partner. They put their liquid LNG products or vehicles into in JV. We provided the equity, but the bank market was shut. Typically, most folks would have to put their pencil down.
Yeah.
We really marshaled our resources and raised $1 billion for financing to have a successful transaction. So for us, these are the markets we thrive. firm is doing extraordinary and hitting on all cylinders.
Jim, you said that the markets are closed, and they were for the most part until last month, where they reopened with a vengeance, and you saw everybody flood back to the market, money pile into even the most speculative debt, people basically sounding the all clear sign. What do you make of that, and how do you sort of adjust your view then perhaps in May when you said that recession was 1/3 to 2/3 of your base case, and you were talking about not taking that duration or liquidity risk?
Yeah, I think you got to differentiate between a rally in credit and the markets being open. The reality is, and it's been well publicized, that a lot of financing commitments have been hung, if you will, nowhere near what they were in 08, probably 80 billion plus or minus versus the 400 to 500 billion. But new financing commitments are very challenging to secure today. We're a leader in private credit. We extend credit. We borrow in those markets as well. But the reality is the IG market's open. But the lower quality high yield markets, still very few transactions are getting done. Very few new commitments are being made on buyouts. So it's not as clear as you said. Again, please don't differentiate a rally in credit versus really an open, thriving financing market.
Jim, can I ask you what you think of that rally in credit, though? 140 basis points of spread tightening on high yield in the last month alone. We've got guests lining up calling that wishful thinking. What do you call it?
Yeah. Well, it's interesting. We typically, when spreads go to 600, we usually, that's a buy signal for us historically. They were there for just a short period of time. As you said, they've rallied dramatically. It feels like the rally, I would say they're on the richer side of fair value than they are the attractive side of fair value. But I think it's interesting to contrast that to the private markets right now. You can, a year ago, high yield indexes were in the mid 4s, maybe touching 5. You can be part of a senior club in private credit right now with spreads, SOFR plus 650, which is basically almost touching 9.5%, 10%. High quality first lien position, top of the capital structure, 30, 40 LTV. So that's an interesting marketplace. And we're open. We've been active at Apollo and at MidCap. The generic on the run high yield market, not particularly interesting. And I suspect you're right. Lisa mentioned I was of the view that a recession was in the cards in 23.
Yeah.
We still believe it will be. I don't think it's going to be a deep historical recession. As we all know, the numbers right now, you're having negative GDP numbers with 400,000 new employment per month. So it's not your father's recession by any means. It's a different kind of environment. But from our perspective, if you have the ability to navigate, it is quite interesting, as many are on pause.
Jim, I've got 20 seconds to squeeze this in. This is the question where the person behind your camera starts waving their hand saying, don't answer it. You were considering helping Elon Musk finance that Twitter bid. Given how it's fallen apart, has that left a bit of taste in your mouth around doing business with him potentially in the future? Just a yes or no, your thoughts on it?
We're a big player in the global financing markets. We finance lots of folks. We're very thoughtful about what we do. And we got a long-term track record to prove that out.
Everyone in that room is going to be very happy with that answer, Jim.
He read that off a cue
card. I'm sure they had it written down.
John, Zelter read that off a cue card like Powell does at a press conference.
Good job.
Hey, Jim, thank you. Fantastic to catch up with you. Some insight there into the credit markets and beyond. Jim Zelter there of Apollo Asset Management from New York City. Jobless claims in America up next. Futures positive 0.1% on the S&P 500. We're up about 1/10 on the Nasdaq too. Yields come in 3 basis points, 267 on a 10-year. Mike McKee ready to break down the data. We'll do that next. This is Bloomberg. Economic data in America about 8 seconds away. Live from New York City this morning. Good morning. Futures positive 0.1% on the S&P. On the Nasdaq up about 0.2% now. Yields are lower by 4 basis points on a 10-year to 266.66 on a US 10-year. With some data in America, here's Mike McKee.
Good morning, John. Well, it is the same story with jobless claims that we've seen the last couple of weeks. A small rise 260,000. The number last week was 256. Now, that's not the revised number. The revised number we're waiting for to come up here in just a second, and we'll see what that was. The trade balance comes in lower than forecast. It's $79.6 billion, down from 85.5. The forecast was for 80, pretty much flat. So that is another addition, since that's a June number, to second quarter growth, which is not a bad thing. We're down 5,000, a decrease of 5,000 in the jobless claims numbers last week. This week, we are waiting to see where we come up with the new number in terms of what the change was. Now, the important number here is becoming different. It's going to become continuing claims from now on. We want to know, if you lose a job, are you getting a job with all of these openings? And we do see continuing claims rise to 1,416,000 from 1,368,000. So an increase there. That's a trend to keep an eye on, because with all the job openings that we have, in theory, the Fed's theory is that if you lose your job, you can get another one. So we will watch continuing claims, how many people are still getting claims. Now I got this number. Last week, 260, they revised it to, so 254 rather. So now it's an increase of 6,000 from the previous week.
I want to talk to you about your tip point. With all your years of experience and that you've had more meals at the Pioneer Grill at Jackson Hole than anybody I know, I want to know your tip point on claims. Is it 280, as we heard from guests this week, or is it a higher number, a more tense number from you?
I think it would be a higher number, but the other thing I would say is that I would be watching the continuing claims now, because if we do see people lose jobs, and this is the Fed's theory, if we see people lose jobs, there's so many job openings, you can probably get another job. So we'll keep an eye on the labor force and whether or not people who move into unemployment are moving off again relatively rapidly.
Mike, just quickly here on the trade balance, because this is something that I've been looking at in terms of the shipping costs that have gone down dramatically, especially for the United States. How much is this all just a foreign exchange influence that basically that is a disinflationary force where the U.S. is able to export a lot more in dollar terms based on the adjustments there?
Well, it's interesting, Lisa, because what we're seeing is a larger percentage rise generally in exports than imports, which is not what you'd expect on a foreign exchange basis. So at this point, that's helping the U.S. bring down its trade deficit. Have to see why that is and whether that's going to continue. We have, I know, seen more Boeing shipments, and those are very expensive than people had anticipated. So it could be something involving transportation, but it is kind of interesting. Last month, we saw a big drop in imported cars into the United States. Nobody can build them, whether they're in Canada or Mexico or the U.S. So that may be what's accounting for part of that as well.
Mike McKee, thank you. 260 is the number then. The previous number, 254. That's your revised number, 254. Claims heading in the wrong direction then. Very subtle move, though, up about 6,000 over the week. On the week. Futures right now, up 0.1% on the S&P. Tom, on the NASDAQ 100, up a little more than 0.1% as well. So we grind out another morning of gains, potentially. Yields lower by 3 or 4 basis points on a 10-year.
And, John, but very importantly, look what 210s does. It gets right down to the pre and Misra mark. I mean, there we are, 39 basis points.
There's your move, Tom.
I mean, it's just simple.
It's a big move.
Inversion.
Look, when Priya said this on this show a number of weeks ago, Tom, it sounded pretty out there.
More inversion.
Here we are.
We begin our jobs coverage now. We do it with our great Michael McKee, and then we move to Thomas Porcelli. Tom Porcelli is chief U.S. economist at RBC Capital Markets, and first came to my attention with absolutely brilliant study of the wage dynamics of the United States of America. Tom Porcelli, good morning. I want to talk to you about what we just heard from Professor Blanchflower at Dartmouth, where he said basically a linkage of these tumultuous times into wage growth is unfounded. Give us your update on America's wage growth in this 9% inflation we're facing.
I completely agree with his assessment. I think that people that are comparing today to the 70s/80s, I think that they're doing us a disservice. I think that this probably has much more in common with the 40s than it does the 70s. I don't think that this is some wage price spiral that the Fed is trying to or can impact. And I think that that effort will bear very little fruit I think the Fed is hiking pretty aggressively into an economy that's very clearly slowing down. I don't know how that ends well. I think, if their thought process is, well, we got to really tamp down on wage pressures, I don't know how much more you want to tamp down on those. I mean, in real terms, they're deeply in negative territory. I mean, I always sort of marvel at the idea that I think very few people appreciate that disposable personal income, nominally, in nominal terms, from the beginning of the year to today, is really up only modestly, nominal. But in real terms, you're deeply in negative. So that whole idea, I think, is sort of foolish. And I would say one last thing, Tom, and then I'll stop. This idea, and Mike McKee was talking about this a moment ago, he's right. The Fed keeps on sort of, hanging their hat on the idea that there's, people can find a job really quick and et cetera. And make no mistake, in certain industries, that is still true. But job openings are not the thing we're supposed to be hanging our hat on. It's a massive lagging indicator. They fall in earnest in the midst of a recession. In other words, they're a free option for companies. And we're already seeing them slow now in a more meaningful way. So, this idea, and by the way, sorry, one last thing on that. This idea, too, that there's, 2 job openings for every person unemployed, that is not correct. You have to look at people also that are not in the labor force that want a job, right? A completely separate metric. And when you add that to the number of unemployed, what you actually see is that the ratio is actually 1 for 1. And actually, just to be clear, it was 1 for 1 prior to the most recent job openings number. Now it's less than that. So I have no sympathy for that view in any way.
So, Tom, translate that picture into what we're expecting tomorrow with the jobs report that we get out there and the anecdotal data that we're getting from a number of companies that they are starting to cut back workers.
Yeah, Lisa, I think that's exactly right. I mean, again, I know you guys were talking about jobless claims, what number starts to scare you. I don't know why you're not scared now. I mean, it's, you don't have to wait for some magical 280 or 300. I mean, you're up from 166,000, right? That was the low that we hit in mid-March. And so from that point to today, we're now up 50%. Now, I know the standard retort on that is, hey, but we're coming off of really low levels. Okay, you were coming off of really low levels in 01 too. I mean, they were historically low then, but hey, we managed to actually lose jobs and the unemployment rate wound up rising. So the level thing is not compelling, it's the move, right? It's the delta. And the delta is incredibly compelling. You're up 50% from the low. And sorry, just to be clear on that. So if you look back to every recession, we went back to the recession that started in 1969. If you look at every recession, from the low into that recession, you're up about 30%. Here we are up 50%. And yes, I know there's some seasonal thing, I get all of that. But even if you adjust for that, you're still up wildly. I mean, it's not a good outcome.
A lot of people would argue that you're coming from a point where everybody had been taken out of the workforce and then brought back in this sort of artificial breach as a result of the pandemic and the global economy shutting down. As we look forward, is your argument that the Fed should look through this and stand pat, not raise rates that much or at all, and sort of wait to see what happens, even in the face of 9.1% headline CPI?
I have a lot of sympathy for lifting rates. I think, look, and you all have heard me say this before. I mean, I think the Fed was very, very late to this. I mean, I would argue that today we should be 100 basis points higher because the Fed was much more aggressive, sort of late last year. But so I do have a lot of sympathy for that. I just think that we have to be careful and ask aloud, do you think that these interest rate hikes are actually going to scale back on inflation? I think inflation is going to slow organically. I know that's a tough pill to swallow for the Fed, and I know they can't stand idly by and wait for that to happen. So they have to keep on raising rates. I just think we have to be careful about the level of rates that we get to. I don't know that we have to get wildly into restrictive territory. I mean, look, let's be clear. Prior to things starting to turn pretty squishy over the last few months, the backdrop did not need any accommodation. I mean, we should have been at neutral a while ago. But I think now we're in so many ways, I feel like we're fighting yesterday's war on inflation. And moreover, I would add, there's certain components of inflation that have been doing some pretty heavy lifting that the Fed has zero ability to control, whether that's food or energy, things that are obviously now receding to some extent. But I think about some of the inflation components over the last month or two, like auto insurance or car repair. I know that might sound like these small little things. They added like a tenth, right? They added a tenth or more to the headline, to the month-on-month gain. That's an enormous number that, again, the Fed has no ability to control. People went out and bought a bunch of used cars. They are breaking down and they need more insurance. I mean, what can the Fed do about that? So I just think the Fed has to be honest about the things that it can and cannot control.
Tom, I want to finish up with this.
Yeah.
The Federal Reserve and where Fed funds peaks. Where does it peak for the team over at RBC?
Yeah, so we think you get to the midpoint would be 3.375. So basically, they hike over the balance of this year. We think that that's reasonable still at this point. I know it's probably sort of in line with what the market is saying. I don't know if I like that or not, but that's where we are right now.
Hey, Tom, it's awesome to catch up. Thank you, sir. Tom Porcelli of RBC Capital Markets. TK with some strong thoughts on jobless claims. Heading in the wrong direction over the last few months.
Well, it's a trend. That's all there is to it. And, that'll play out. But far more important is the jobs report tomorrow. Are we all three here for the report tomorrow,
We
John?
are in for payrolls. Lisa and I are always here.
Oh.
It's you that's questionable at times on Payrolls Friday. You're going to be here?
Yeah, I'm going to be here.
Looking forward to it.
I'm not going beige suit, though. It's a serious day.
You'll prep for tomorrow. No baseball, right?
Today was not a serious day.
He's not taking today seriously at all.
The tang will be stronger.
No, because it wasn't Jobless Claims Thursday.
Yeah.
When the man from Del Monte walks into the studio to cover markets, I question how serious he is.
Yeah.
Coming up in the next hour, you asked for that,
tomorrow,
you did. Troy Gajewski of FS Investments in the next hour, alongside Chris Harvey of Wells Fargo and Rubber Bank's Jane Foley. You're impossible to ignore. You know that. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The Bank of England is warning that the UK is heading for more than a year of recession. That came today as the central bank raised interest rates by the most in 27 years, a half percentage point. BOE policymakers also estimated that inflation may peak in October at 13.3%. And in the UK, Foreign Secretary Liz Truss has rebounded from an embarrassing policy U-turn to regain the momentum in that race to become Prime Minister. Truss received the backing of former Chancellor Sajid Javid. That is a blow to her rival Rishi Sunak. Javid wrote in the Times newspaper that Truss would challenge the status quo and deliver immediate tax cuts. Bloomberg's learned the Biden administration is lobbying Democratic senators against a bill that would alter U.S. policy towards Taiwan. Amongst other things, it would designate Taiwan as a major non-NATO ally. Tensions between the U.S. and China were exacerbated this week by House Speaker Nancy Pelosi's visit to Taiwan. In response, China began military drills around the island today. And Amgen has agreed to pay $3.7 billion for ChemoCentryx. It's a biotech company focused on developing drugs for autoimmune diseases, inflammatory diseases, and cancer. Amgen will pay $52 a share in cash. That is more than twice ChemoCentryx's closing price on Wednesday. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
We think 9%, we're kind of trending around 9%, maybe 8.8 for the next few months. By year end, somewhere around 7%. But the year-on-year comparisons get much easier next year. And that's the key. And you don't need outright price declines, right? The levels don't have to decline. Just the month-to-month change has to slow.
Kathleen Bush-Johnson, she was absolutely lights out yesterday, Lisa, with Oxford Economics. I just thought she was great, piling into this jobs report tomorrow.
Yeah, and it's really an interesting moment when there are a lot of people saying that this is the key indicator the Fed will be watching to determine how quickly they can back away from some of those rate hikes that they've basically forecast.
Sterling with a little bit of a rebound, a 120 up to a 120.105, but still the shock of the Bank of England meeting. We've got the claims report coming out, U.S. futures up 7, et cetera, but also the churn in Washington. And there's so many themes we've covered this morning. Right now, we are advantaged with Greg Valliere. He is Chief U.S. Policy Strategist at AGF Investments. And Greg, I really want to go to the broader tone. I want to go away from what I read in the Washington Post and the great Bloomberg politics people to the senator from Wisconsin who was talking up like he owns the high ground. And Ron Johnson beat Feingold, the Democrat, by 50.2% of the vote the last time around. And Ron Johnson's coming out with statements that you and others would suggest really cause risks to the Republicans.
Well, I tell you, Tom, this has got to be Mitch McConnell's worst nightmare. He's got some bad candidates in Georgia, Pennsylvania, Ohio. They have overdone the abortion issue, which I think has backfired on them, as we certainly saw in Kansas. And you're right, Tom. Here comes Ron Johnson of Wisconsin, who says yesterday, maybe we have to change the structure of Social Security, make it something that has to be renewed every year, which would be a nightmare, of course. People would use that as a hostage for other legislation. I mean, are they trying to blow the Senate election this fall? I mean, the House is going to flip to the Republicans. I think that's pretty likely. But all of a sudden, the Senate is very much in play, and Johnson is a factor in this.
Is there a middle ground for Republicans? I think with Taiwan, we saw that with Mr. Romney maybe taking a different tack than Rubio and other Republicans. But can McConnell and the Republicans find a middle ground that can salvage their Senate election?
I think so. There are an awful lot of Republican Senate candidates who are saying they would not support Mitch McConnell for another term as the leader of the Republican leader of the Senate. So it's a very, very divided party right now. And I think this is a shocker to all of a sudden see 3 or 4 or even 5 Republican seats look shaky, and maybe only a couple of Democratic seats look shaky. In a 50-50 Senate, the Democrats have a path to keep control.
This comes at a time, Greg, where the Democrats are trying to push through the Inflation Relief Act of 2022, the reshaped Build Back Better bill, and reframed in a new way for a new moment. How much do you view this as a likelihood, and how much do you view this as actually helping the Democrats heading into the midterms?
Well, I tell you, Lisa, all of a sudden you've got to conclude this bill is in trouble. Some provisions are going to have to go. Kristen Sinema, the moderate Democrat from Arizona, does not like anything on carried interest. I've been joking that carried interest is like Rasputin, cannot be killed. And it looks like this may wind up staying in the bill. She also, I think, has problems with the corporate minimum tax of 15%. So I think the bill is going to have to be rewritten to a certain extent. They were planning to leave tomorrow in the Senate. That can't be done and hoping to get a bill. It could be after Labor Day before a bill is done. And I think the bill could get even smaller.
There's a broader question here about the ability of this Washington to take fiscal action at a time of inflation as we head into a lot of what people are saying is going to be a recession. You see this over at the Bank of England, that they are hiking rates today. There is an expectation on the fiscal side there will be aid to offset the pain from that felt by the consumer. In the United States, is that kind of fiscal support off the table because of the politics right now and because of what the spending, how it was perceived during the pandemic?
How is this for an irony, Lisa? You've got very restrictive monetary policy now and restrictive fiscal policy just as we come close to a recession, when maybe you could use a little stimulus. So, yeah, I think that the mood in Congress is to not spend much more money.
Greg, one last question here. We've got so much going on today. What is the legacy that Speaker Pelosi earned from this trip to Taiwan?
I can't figure it out, Tom. I don't know why she did it. A lot of people in the Biden administration asked her not to do it. I know she feels strongly about human rights in Tiananmen Square, but I think she stirred the pot in a way that was not constructive.
Greg Valliere, thank you so much. We value your notes each morning. And of course, folks, we protect the copyright of all of our guests. Look to AGF Investments Toronto and somewhere. He's in a shack up in New Hampshire somewhere. AGF Investments will get you the reports of Greg Valliere as well. Lisa, I don't even know where to begin on today. What is your thought as you look at the Bloomberg screen?
Well, just the resilience of stocks amid pretty much a consensus of gloom when it comes to the economic picture. Stocks are not the economy, and you do see an incredible bifurcation in terms of the income tiers. There was a Wall Street Journal article recently highlighting the savings rate for the lowest income, the middle income, upper middle income, and upper tier of American households. The wealthy are doing well. Their savings are being built out dramatically. The poor actually built up more during the pandemic because of the checks. The upper middle class is getting squeezed on every level, building debts, not being able to spend as much in real terms. And how does this bleed out in an economy that is really an economy of averages that really gloss over some of the nuance under
And
the
Tom
hood.
Porcelli mentioned that with the real wage or lack thereof, and the scale of it, I should say, as well. I hate to do this, Lisa, but I think we've got to talk about Pharaoh's United Kingdom today. I knew it'd be a big deal, but I just simply, the language that we heard from Governor Bailey, for those just tuning in, absolutely original. You'd never see that by the Fed.
Lee Ferridge of State Street came on the show earlier this hour and said it was a bellwether moment to have a major central bank come out, hike rates by 50 basis points, and project a deep recession that had staying power. This shows the conundrum that banks are in as they face a stagflation type of environment. It is incredibly difficult, and it is something you're going to see in different shades, in different tones around the world.
Incredibly popular demand has forced the three of us to be with you tomorrow morning, and I have to believe it will be a more than important jobs report. Lisa, I'm going to be looking at the revisions, the look back one time, the look back two times, and adjusting those revisions into the pretty good number we're going to see as well.
I'm going to be watching wages. That gives a sense of how much pressure there is. Anecdotally, we are hearing about cutbacks. Walmart cutting about 200 corporate jobs. A number of companies have come out and talked about retracements. How much is it one-off? How much is it industry-specific? And how much do you see that in how much people are demanding higher wages and actually getting them?
And with the Bloomberg reporting this morning, perhaps a small cutback in Zurich as well at Credit Suisse. That'll be one of our themes of coverage today on radio and television. We are steeled for the jobs report tomorrow. We hope you'll join us. We'll start in strong with the usual victims with us. Looking forward to that. See you tomorrow. Alan Blinder at 12 noon today. This is Bloomberg.